It's 9 a.m. live from the Nasdaq market site in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance Live. Here's your morning rundown. The sell-off continues. The 10-year Treasury yield trading only a few basis points below 5%, hitting fresh 16-year highs on fears that stronger than expected data could drive the Fed to keep rates higher for longer. Now, investors are desperate for more clarity on where the economy is headed. Ask and you shall receive. Fed Chair Jerome Powell is scheduled to speak at noon today.
Plus, Tesla flipping on the hazards. Price cuts took a toll on the EV maker's bottom line, with net income falling 37% on an annual basis. Elon Musk was all jitters talking about the year ahead and tempered expectations for the long-awaited Cybertruck. Meanwhile, Netflix is hiking prices yet again. Tough news for views, but an encouraging sign for investors. Netflix says that they've got a long runway of margin growth.
In turbulent skies for American Airlines, the company cut its 2023 profit forecast after posting a quarterly loss thanks to high labor costs and also jet fuel prices. Now, this is also a cause for concern. The resilient consumer may be softening just slightly.
Well, our top morning driver here, they say the bond market leads, and it's certainly grabbing investor attention this morning here, especially as the 10-year yield flirts with the 5% level and pressuring stocks at the same time. Volatility in the bond market has been elevated lately, and the next few hours will be key ahead of a policy speech from Fed Chair Jay Powell.
Well, this morning, former PIMCO CEO Mohamed El-Erian tweeting out on Fed policy. He said that, as many of you know, I have been uncomfortable about how extremely data dependent this Fed has been, especially given the obvious point that its tools operate with a lag. He is a man who knows the bond market better than most. We will speak to him later this hour. But Brad, let's unpack exactly what's happening right now. We've had this massive historic rise in yields. When you take a look at the 10-year, right below 5%. And I think a lot of people are asking, or the great debate out on Wall Street among many, is whether or not this is going to put enough pressure on the economy for the Fed to hold steady. So we're going to hear from Jay Powell later on today. And I think investors are just going to be listening for any clues as to how the Fed is assessing the rise in yields, what that could mean for the economy, and also just how that's going to impact policy here down the line.
Yeah, spot on. And in terms of what some of the Fed officials are saying right now, we've got a ton of Fed speak that's been taking place over the past couple sessions here. And yesterday, one particular caught my attention here, as well as some of the other economy writers out there. Philadelphia Fed President Patrick Harker, he had some words about where the central bank should perhaps be sitting on its hands for a little bit, and perhaps even until early next year. And what he had said ultimately is that this is a time where we just sit for a little bit. It may be for an extended period, it may not, but let's see how things evolve over the next few months. And he's going to vote on interest rate policy, of course, this year. And I think that really sets the tone for perhaps where we could hear some of those voices in that next November meeting, just weeks away at this point, to come, and where there could be more of an inclination, even as we've watched the CME Fed Watch tool start to move more of that probability higher into the sitting, waiting, seeing how the economy is continuing to digest some of the policy moves that have already been enacted, where those voices might ring louder in this coming meeting.
Yeah, and taking a look at what we're seeing right now, 93% traders expecting no hike in November, 61% saying that they could actually be done for the year. So certainly we do see those odds continuing to skew here to the upside when we talk about what Fed policy could potentially look like. But we know that Fed officials have said, and Powell, I should say, reiterated time and time again, that one more hike is likely here before the end of the year. That was obviously in the dot plot projections. In terms of how much pressure that would even have on equities is also up for debate. We've talked to a number of strategists here over the last several weeks saying that another 25 basis point hike from here doesn't necessarily dictate much of the move here from here on out towards the end of the year. But I think it's more of that higher for longer, and whether or not the stabilization of long-term rates, what that's going to do to the equity market, what that's going to do to the bond market. And of course, we know there has certainly been a divergence in the performance of the bond market and the stock market, and exactly what the long-term rate, where that settles, how quickly we could potentially pull back from those higher levels, and what that could then play out in the markets is something that every investor is trying to figure out.
Yeah, and the investors, even thinking back to over the summer where we started to get more of this talk about maybe they weren't finished yet. A lot of that equity market activity perhaps already ensuing here, as we had seen. You look back to July, beginning of July, and the move that we've seen in the S&P 500 from mid-July, or from the beginning of July rather, even to this point. You're seeing some of these moves where the S&P had been down about 6% from that time. The Nasdaq Composite over the past over the past kind of 3 months even, and even if you kind of just look towards the beginning of July, down 7% since the beginning of August here. So all of that considered, there have been even more since that point, that late point of the summer, where we've seen the equity markets try to get ahead of the Fed as best as possible. And so for that move, as well as combined with where there could be a rug pull of some of that AI sentiment as well, which is, as we've discussed, turned into a show me story. That's been that combination of the equity markets looking across what's been most speculative, plus what they can actually digest or best get ahead of right now. And that is not trying to fight the Fed, but trying to anticipate the Fed as best as possible.
All right, well, let's get to one of our big movers of this morning, and that is Tesla. Shares are extending their losses in the pre-market trading. Now, the stock initially popped after reporting its fiscal third quarter earnings after the bell on Wednesday. But once the call started, investors started to sour on these results. You're looking at losses of just over 6.5%. Here with what went wrong, Yahoo Finance senior autos reporter Praz Subramanian. Praz, looks like the street's not too satisfied with these results.
Yeah, hey, Shauna. Yeah, kind of big picture there, that miss in the top and bottom line, slight dip in margins, sort of kind of weighing on the stock. And then, of course, a number of things also coming up there for the company. And then also sort of the sort of concern about, so the global economic environment. But yeah, on the call last night, a number of things came up with Musk, CEO Elon Musk, talking about three big things here. I want to note Mexico, the status of that plant, the Cybertruck, and of course, outlook there for the company. So with Mexico, that's the next giga plant that came up in the call, and Musk sort of surprised someone. He said that they might be backing off on fully building out the plant at this time. Here's what he had to say on the call.
We're laying the groundwork to begin construction and doing all the long lead items. But I think we want to just get a sense for what the global economy is like before we go full tilt on the Mexico factory. I'm worried about the high interest rate environment.
So Musk mentioned that high rate environment multiple times. I heard you guys talking about that just now earlier in the show. So, and that's sort of also on his mind as a sort of a weight on the sort of build out of the plant, because he's concerned about where the economy will be and whether they need to keep making cars and expanding their volume there. So secondly, the Cybertruck, of course, huge news. They announced that the November delivery date in the shareholder deck, they teased it with the picture there. And then they tweeted out that actually the November 30th will be the actual event date for the delivery. So good news there, but it wasn't all good news for that Cybertruck. Musk sort of painting a dim outlook, talking about how, quote, we dug our own grave with Cybertruck, warning that the production of that car is an enormous challenge, and reaching volume production will also be a challenge. And he added that it'll probably take 12 to 18 months before the Cybertruck is a positive cash flow contributor for Tesla. So not exactly the savior that many had seen for the Cybertruck for the company, right? Finally, outlook. Tesla reiterating that 1.8 million unit production forecast, hinting that sort of Q4 will be a big quarter if they're going to meet that goal. Long term, it's hard to see how a slowdown in Mexico helps them reach that 50% CAGR growth rate that they've talked about before. It seems that Musk was asked about that growth rate, and he laughed it off, saying that if we did that, you would have more cars than the world would ever need. But it's funny because Tesla was the one that came up with that target as their long-term growth rate. So that's sort of ironic there. A little outlook point from Musk and Tesla last night in the call.
It's really interesting. Everything that you were breaking down there, Praz, especially on the Mexico plant, which if that impacts the Cybertruck, that's perhaps enough to make optimists' ears go ruh-roh. But at the end of the day here, you got to think about where this company is able to still, in the interim period, bring in margins, especially amid this pricing war. Did they give any type of details around where margins are either under pressure as we were tracking these results, and knew that there was going to be some strategy to place attention on the Cybertruck, especially while there's this margin pressure that is ensuing as a result of their pricing mechanisms that they've put in place over the most recent quarter?
It's interesting. Margins came up a lot in the prior last quarter's conference call and didn't really come up much here. I think it's a given that Tesla is saying, we're going to go for volume and we're going to sacrifice margins as a result. And 17.9% gross margin is not that bad when you compare it to the other automakers there. So I think there's the street is probably saying, we accepted this story. Musk did say, though, or Tesla did say that the expansion and sort of productivity at Giga Berlin and Giga Austin was improving. They're going to see more volume there and probably better productivity, so that might balance out any potential effects of cost cuts for those cars. So that's a positive. And then that Gen 3 platform is still supposedly on the way, and that will be when that thing actually is being made in a different sort of innovative way. That'll be a cheap car to make, but also cheap from a cost point of view, and that will also help margins down the road. So I think that margin story right now is sort of taking a back seat at the moment for Tesla. It's more about Cybertruck potential issues or challenges, and then also sort of that outlook. Can they reach that outlook given what's happening with the global economic environment?
All right, Pras, thanks so much for teeing up the conversation here on Tesla and listening into the call yesterday. Pras, we appreciate it. We're going to continue to discuss Tesla here right now as we're tracking shares here this morning. Tesla taking a hit today after its lackluster third quarter earnings report. One of the key points investors walked away with was warnings around the highly anticipated Cybertruck. CEO Elon Musk saying on the call that Tesla dug its own grave with the Cybertruck. He also called it a special product and said products like it are, quote, incredibly difficult to bring to market, to reach volume, and to be prosperous. Our next guest doesn't seem too worried about the Cybertruck, but he would like Tesla to consider pivoting to becoming a tier 1 supplier. Let's bring in Tom Narayan, who is the RBC Capital Markets lead equity analyst in global autos. Tom, broad strokes first and foremost here. I want to get your takeaway from what you heard on the call and what Tesla had to report in this most recent quarter.
Yeah, I wasn't actually that surprised, honestly, by the gross margin print. I mean, they took some production intentional shortfalls this past quarter for upgrades. Musk definitely had some commentary on 2024 that kind of spooked investors. Cybertruck comments you pointed out, Mexico facility, which means we won't have these millions and millions of Model 2s out there. But I think ultimately we're all missing the greater point here, which is I think Tesla is slowly trying to pivot away from being a huge volume car maker and into becoming a tier 1 supplier to other OEMs. We've seen what they've done with charging infrastructure. They're making so many batteries subsidized by the US government. They do power electronics, the biggest maker of these. I think they sell these things to OEMs and then ultimately get really what they want, which is licensing and selling FSD, which is really the profit center, and gets them to the next step, which is robotaxi. So it's part of the roadmap that begins with cars as a proof of concept and migrates to becoming a tier 1 supplier and then eventually a robotaxi maker.
So, Tom, if investors aren't appreciating that from your point of view, I guess what does that then tell us about valuation or how Tesla then should be valued given this pivot that you see Tesla undergoing right now?
Yeah, I think it's, a really good comparison I look at is, I don't know if you guys remember Netflix in like 2011 to 2013 went through a weird transition of renting DVDs to streaming. And it was a problematic transition. It wasn't communicated well and the stock suffered. Here, I think what's happening is Tesla is trying to make this transition very gradual and communicate to investors gradually what they're trying to do without just yanking the blanket off the rug. So I think now what's happening is on valuation, people will see all they have to do is cut some pricing on FSD. That will show margins increasing. People will actually see how amazing that product is. And they'll pivot in how they value the company. Instead of looking at it as a car company, they'll start looking at it as a software company, assign a higher multiple. And once you start seeing them winning licensing deals with FSD, I expect folks to start looking at this as trading at a 10 times revenue multiple on forward sales as opposed to earnings or EBIT or whatever people are caring about right now during these earnings calls.
But there's a lot that has to go right in order for robotaxis to be and to hit critical mass and to be an everyday option for a lot of riders out there at that point, or potentially even other companies who they would be licensing or selling into. What does Tesla need to get right along that roadway?
Yeah, I mean, you're absolutely right. This is no easy path. The way I look at this topic is top down. I believe in robo-taxis. They are the future. They will transform society for the better. Regulators want it. So I believe it will happen. And I also believe it'll expand the pie for autos tremendously. It'll take share from other forms of transportation. It's a bedroom on wheels. It's a living room on wheels. It'll just make autos so much bigger. So then I just
but from how you're valuing it.
Yep.
But from how you're valuing it, Tom, what time span do they need to complete that buy?
No, I'm valuing it by 2040, and then I'm discounting it back. So this is definitely far out. Cities have to be re-engineered for this to work. No doubt about it. This is not something that has to happen overnight. I think it's a proof of concept model. First, show FSD. That gives people faith that they have the best technology. You'll also see regulatory environment get in there. I think regulators will mandate FSD type products. They save a lot of lives. FSD is 5 times safer than regular cars. And then that'll give them more credit to run with. And then, by 2030, 2035, you'll see way more of these robo-taxis on the road. People get more comfortable. So it's a slow bleed. It's not going to happen overnight for sure.
Tom, I know you're not focusing a lot on the Cybertruck here, but I got to ask you because the street is focusing on some of the comments that we heard from Musk just in terms of how challenging this product has been to produce and what that runway looks like going forward, or how long it's going to take until we do see the Cybertruck be profitable here for Tesla. What does this tell us just about how challenging bringing a vehicle like this to market is, and what you think that opportunity realistically looks like for Tesla?
Yeah, and I do want to just make a note about the conference call itself. I mean, I've listened to several of these conference calls, and sometimes it depends on Elon's mood. And you have to kind of keep everything with a pinch of salt when he's talking about stuff. So I think what he was getting at is how technologically sophisticated Cybertruck is. His goal is to make it affordable for regular folks. If you look at the pickup truck market in the US, the EV pickup truck, they're super expensive. So it's going to be challenging to make this thing profitable, given how technologically advanced it is. I don't think people should come away with this as going to be a boondoggle or anything like that. This will ultimately be profitable. But at the same time, this was never meant to be a very important product for this company. Ultimately, this company's all about FSD, all about autonomy, all about robo-taxi. Don't get caught up in the noise. It's a great product that they have to highlight their technological advantages, but I don't think it's something that derails a story.
All right, Tom Narayan, always great to get your perspective. Again, Tesla shares under quite a bit of pressure here ahead of the open, off just about 6.5%. Tom Narayan, thanks so much for joining us. Let's get to our other big mover of this morning, and that is Netflix. It's coming for your wallet. Once again, the streaming giant is hiking its prices for both its basic plan and premium plan, now sitting at $11.99 and $22.99 respectively. The company did say that it saw a turnaround in subscribers in its earnings release last night, surging 8.8 million in the third quarter as its ad tier addition and password crackdown proved to be beneficial. Netflix also giving strong profitability metrics here, with operating margin hitting 22.4% in the quarter. CFO Spencer Newman gave some context for the streaming giant's margin targets on the earnings call. Let's take a listen.
There's no change in our financial objectives, and also no change in our long-term margin expectations, including the fact that we don't think we're anywhere near a margin ceiling. We've got a long runway of margin growth.
All right, for more on this, we want to bring in Brian Mulberry, Zacks Investment Management Client Portfolio Manager. And let's break down what we just heard from Spencer Newman there, because I think this was one of the bigger takeaway from the earnings call, just in terms of that runway growth that they see for margins. What do you think is realistic? And do you agree that you don't see Netflix anywhere near the ceiling when it comes to margins?
Yeah, absolutely. When you're talking about subscriber growth, the way that they have accomplished it and being able to raise prices by almost 20%, that creates an enormous amount of revenue growth. We see revenue growth by about $1 billion year over year from where we are today going into the same time period next year. So that's substantial. And so I think, yes, there's quite a bit of runway that's very positive in front of them. In the near term, the challenge is going to be all these exciting numbers, lots of eyeballs watching, but where does the content come from? Does the strike in Hollywood affect them in terms of their ability to continue on this type of a pathway? So obviously very exciting blowout numbers, no question about it. What we really want to see is making sure that they're capitalizing on the great content that they had previously and that they can continue to produce that. Obviously some very high quality content, getting a lot of awards and accolades, and making sure that that stream of content is catching up with the amount of excitement that we have in terms of new subscribers, and hopefully people are still willing to pay that new price as well.
Yeah, strike was one of the first things they brought up on the call, Brian, and to your point there, even as they were recognizing, and Ted Sarandos, the co-chief executive officer there, saying we're incredibly and totally committed to ending this strike. Industry, communities, economy all hurting, so they need to get a deal done. But what does a done deal for the broader industry that they're talking about that's equitable to both sides? What do you believe that looks like?
Well, I think, what happened with the writers seemed to be pretty equitable in our view, in that there's a little bit more of a longer life cycle for some of this in terms of their product, right? What they're writing, the creative content, it's living longer now that you can go back and restream it and watch it as many times as you want to. So it makes sense to have a structure out there that helps with their kind of trailing commission, if you will. The more views their content gets, the more they should make, because that really makes sense to us. So something along the same lines or the same type of a structure for the actors would make sense. It seems like they've got a good roadmap going forward to accomplish that. And so we would expect a deal hopefully to be done sooner than later.
Brian, when it comes to that future growth that we've been focusing on here, obviously the password crackdown and the ad tier, the introduction there of that new platform driving a lot of the growth that we saw this most recent quarter. But when it comes to future growth, where do you see that coming from outside of the fact that obviously if they spend a lot on content, have that critical content, unique content, that of course is going to keep people staying with Netflix?
Yeah, absolutely. I think the runway for them to grow is going to be outside of the U.S. Their international exposure, their foreign language commitment to content, now they have subscribers from over 100 different countries. And really that provides an enormous amount of uplift in terms of new subscribers outside of North America. I think that's very exciting for the company. And they really have spent a lot of time and effort creating that foreign language content in multiple languages, obviously geared toward multiple different audiences. And I think that's a really exciting place where Netflix could really enjoy a lot of growth, more so than its competition at this point in time.
Yeah, certainly. And I mean, they kind of gave some of that history too on the call, talking about investing heavily to launch global in 2016, taking a disciplined approach to kind of getting to and building profitability as they grew revenue. But ultimately here, for how this company is also going to tap into different types of streamers that are out there, even internationally, it also comes with this realization that maybe they do need to do more in sports. And we're going to have one of the first examples of that this quarter here. Where else do you expect them to continue to invest in live sports or in live types of content features that drive some of those international views?
Well, I think it's live sports is a nice hedge to, maybe a loss of content if the strike with the actors continues for a long period of time. Obviously, you've got a lot of competition there to stream these events. And I do think it would make sense for Netflix to try and at least have some type of a product to offer in order to be competitive in that marketplace. But you guys mentioned it earlier, they came from renting DVDs a long time ago, and they were able to invest organically and change their business model. And so we think that they're at a point now with this amount of revenue generation, they can do the same thing again, organically pivot to something that might be better producing in terms of margins and profitability down the road, but without having to over leverage their balance sheet. And then you guys have been talking about interest rates all morning long. That's a really important distinction in this point in time. If you're having to borrow or finance your future growth today, just like mortgage rates, it's 2.5 times higher than where you were about 2.5 to 3 years ago. And so that's a really important distinction for Netflix. And one of the reasons I think it's getting a lot of attention is that they now have enough free cash flow generating to make these types of bids and changes in product lineups in order to maintain their competitive edge in the peer group.
Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Great to have you here with us today to break down Netflix earnings. Look forward to checking back in the future.
Thank you so much.
Absolutely. Well, we've got just inside of 6 minutes until the opening bell. Let's see what the stocks are doing here pre-market. For that, let's turn to our own Jared Blickery here at the heat map internationally. Jared.
Hey, Brad, we have a mixed market. The Dow is just at break even there. S&P 500 in the green. The Nasdaq up about almost 0.5%. The Russell 2000, the small caps, underwater by about 0.2%. Let's take a look at the 4-day price action going back to Monday. You can see it's been kind of from the upper left to the lower right most of this week, so a bit of downward pressure alleviated this morning, but we'll have to see what happens into the close. I'm really watching the bond market, as I have been like a hawk for some time. Here is the 10-year T-note yield. It is at another 16-year high, 4.93%. We've been talking about this, headed towards 5% probably. That's a cinch. That's not too far. But does it go higher? Does it go to 5.5%? Does it go to 6%? A few weeks ago, JP Morgan CEO Jamie Dimon said he expects 5.5% on the 10-year. That is quite a profound statement to think about. Now, here is the ICE B of A Move Index, kind of treading water recently, not a lot of action there. And then just taking a look at the VIX, we've seen it pushing at the 20 level, but really haven't been able to breach that. Here is a 1-year look, and you can see we do have this kind of resistance area right here around 2022. If it punched above, that would be concurrent with a down move in stocks. Also going to check out the US dollar, which is kind of treading water here. This is a 3-month view, and we haven't done much over the last few weeks. In fact, not much for the month of October, but that's overall pretty good for stocks. We have seen a lot of pressures in the international markets. I'm going to be doing a deep dive on China selling U.S. Treasuries in the next hour. But here's a look at the sector action. We have communication services up 1.32%. Guess what Netflix is a member of? It is thrown in that hodgepodge sector group of communication services, and that is up 1.3%. Industrials in the green, so is staples, but lots of red today. We're seeing energy down about 0.7%. We've been tracking the rise and fall of crude oil. Retail was under pressure yesterday. That is the second worst performing sector. That is down about 0.7%. Just taking a look at some of our leaders here. Cannabis in the forefront. That's up about 3% in the pre-market. It was down 7.12% yesterday. Solar also getting some love. Bitcoin looks like internet stocks in the U.S., transportation stocks, and also defense stocks, and also semiconductors. Chinese stocks, let's take a look at them real quick. They are taking a bit of a hit. We see the big ones like Alibaba down about 2%, NetEase down 1%, Pinduoduo down 1.7%. And let's just take a look at the banking sector as we still see some regional bank earnings rolling in. For the most part, red yesterday and red this morning, and we'll get a quick check of the regional banks as well. If I can punch this up, here we go. Here are the regionals, and actually a bit of green here. We're seeing Truist up 1% and a couple others in the green, but no outsized gains here that I'm seeing.
Bit of a mixed picture here today. All right, Jared, thanks so much. Stick with us here as we look ahead to the opening bell. We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. We got the opening bell on Wall Street. Let's do a quick check of the markets. We're looking at slight gains here at the open, right around the flat line here as investors digest the latest round of earnings. Also look ahead to what we could hear from Fed Chair Jay Powell later on today. Jared Blickery, what do you have? You're looking at the sector action.
Yes, communication services, which houses Netflix, that is the #1 sector of the day, up about 1.5%. Tech also outperforming, that's up 0.5%. And those two right there, those are mega cap sectors. To the downside, we have consumer discretionary, which is also a mega cap sector as it houses Amazon. That is down the most, almost 1%, followed by real estate and energy. Let's get inside the Nasdaq 100 here. A couple of standouts. Tesla, we've been talking about it. I'm just going to chart it real quick. Here is a year-to-date look. Have not come down to the support level right here in the low 200s. I think that would probably be a target, so maybe the selling isn't finished just yet. And then we have Netflix, and we can see this huge bump up here. Let me put a line chart so you can see it. Over the last 3 years, maybe something else comes to light. I think we just kind of had a false breakdown from this upward sloping trend channel here, and we'll see if Netflix can get back on track with this latest win. Don't know about those margins, though. Am I going to renew at $23 a year? Not sure about that. All right, let's take a look at some of the leaders. Meme stocks, that is down 4.5%, followed by gambling and New York FANG. That's interesting. That is a mega cap index, essentially, but also has Netflix in it, so not sure why that would be down. But let's take a quick look inside meme stocks to see if anything is jumping out here. And there we go. Looks like Nokia down 7%. Not seeing too much else in the deep red. Palantir up 1%. But all in all, I think a lot of investors just going to be watching the bond market today, especially for that 5% level in the 10-year. I would expect a small sell-off if we get there in yields, rise in the bond prices. But beyond that, it probably gets a little hairy for equities.
Getting closer and closer to that 5% threshold there. All right, Jared, thanks. Now let's get over to Yahoo Finance's very own Julie Hyman. Julie.
Thanks so much, Shauna. Well, we've been talking about U.S. Treasuries being on a roller coaster of sorts over the last week. We had geopolitical tensions pulling down yields as investors flocked to safe havens, but mounting fears around higher for longer rates are now driving yields to multi-year record highs. Anxious investors now awaiting guidance on the Fed's next steps from Chair Jay Powell. He's scheduled to speak at noon today. And I'm joined now by Mohamed El-Arian, Allianz Chief Economic Advisor, to give us some more insight on what is going on out there. Mohamed, it's great to see you. I can think of no one better than to give us some perspective on this moment. And yes, there's been volatility, but as we speak this morning, we've got across the yield curve, yields at or near 5%. What are the implications for the markets and for the economy?
Thanks for having me, Julie. Yes, at one point earlier this morning, the 10-year was at 4.98. The immediate cause for the latest leg up is news that China reduced its holdings of treasuries by 21 billion in August. And that speaks to bigger concerns that people have, which is where are the buyers? We know we're going to get a lot of issuance by the government, but who's buying? The Fed is not buying, the Fed is selling. Institutional investors, a lot of them are underwater already. Their appetite to buy more here is limited. And there's been questions about China buying because of geopolitical issues. So despite what's happening in the Middle East, yields have been going back up. As to what it means, well, for the everyday person, it means a mortgage rate on a 30-year above 8%. It freezes the housing market even more. It means higher borrowing costs for both households and businesses. So it's not good news for the economy. But the biggest concern out there is the violency of the move, the way we've gotten to 493 right now. And there's a fear, and I hope it's just a fear, that this could break something. And it's important because we have no anchors. Fed policy is no longer an anchor. Fed policy is too backward looking, is too data dependent. So there isn't clarity on where we're going to be when. And the economy is no longer an anchor. So this is a really hard time for the bond market. And we need stability. We desperately need stability.
Well, where the heck is that going to come from, Mohamed? As you say, the traditional buyers of treasuries maybe are backing off or they're at their limit, right? Even if they're still in the market here. What do you want to hear from Jay Powell today? What could he possibly say that would provide that stability?
So what I want to hear from Jay Powell is not what we're going to hear from Jay Powell, just to be clear. What I'd like to hear from Jay Powell is that we are no longer excessively data dependent. We recognize that you cannot drive a car that is on a curvy road looking through the back view mirror. That is what data dependency does. And when your Fed tools operate with lags, it becomes a problem at points of inflections. And we are at 2 points of inflection here, a technical point and an economic point. So what I would like to do is greater vision from the Fed, as did the Yellen Fed, as did the Bernanke Fed, as did the Greenspan Fed. This is the first Fed that hasn't got a single strategic bone in it. It's all data dependent. And if it were data dependent, to be clear, Julia, jobless claims below 200,000, certain inflation outcomes above. Atlanta GDP for the third quarter is in the 5% range. If they're truly data dependent, we're going to get a hawkish message. And the last thing this market needs is a hawkish message right now from the Fed.
The backdrop for all of this, of course, and you're out with a book recently called Permacrisis, which looks at how to attack some of these issues that are persistent and consistent in the world. And I'm reminded of what Jamie Dimon said last week, that this is one of the most dangerous times in the world in decades. He was talking about the geopolitical picture. He was talking about quantitative tightening. Do you agree here? Are we seeing this confluence of events, and are risks rising even at this level?
So he was referring in large part to geopolitical risk and the tragic events of the Middle East and the continued death of innocent civilians is of concern because it inflames feelings and it makes outcomes even less predictable. But if you step back away from this horrific period right now in the Middle East, but if you step back, we've had this notion of what the G20 has called cascading crisis, or my co-authors and I call permacrisis, the sense that we stumble from crisis to crisis. And we believe there are three reasons for this. One is the inability to generate durable, high, and inclusive growth that respects the planet. Two is repeated policy mistakes, and sometimes the same policy mistakes being made over and over again. And three is the lack of global policy coordination. So when you have these three things, you will end up with unusual uncertainty, you will end up with fluidity, you will run down your human resilience and your financial resilience. That's the bad news. The good news is that there are ways, concrete ways to address all three that can get us out of this permacrisis, that can put us on a road of virtuous cycles, not vicious ones. But it's not going to happen in the next 1 or 2 years. This is more a 2+ year outlook. But it is a hopeful book because we believe that you can address all three of these issues.
Now, I know your co-author, Gordon Brown, is more the sort of the politician of the group, so to speak. But I am curious, one of the things you talk about is global leadership as being one of the solutions here. And, I look at a moment, at least here in the US, where the House of Representatives can't even elect a speaker, right? So are we going to get that global leadership? You say it's an optimistic book. Are you optimistic on that point in particular?
And that has been sort of an issue of heated discussion among the authors. And to be clear, this was born of Zoom calls. During the lockdown, three of us, Gordon Brown, Mike Spence, Nobel Prize-winning economics, and I would get together on a regular basis to talk about the world. And it was very frustrating because we were worried. We kept on hearing notions of, when we open up the economy after this lockdown, everything is going to be fine. And we say, that's not how economies work. It's not a light switch that you simply put it on and everything comes on. When you reopen an economy, things are in the wrong place. Then we kept on hearing about how bad the vaccine distribution was. And we kept on saying, be careful, because we could get a variant from South Africa. We could get a variant from India. And then we pivoted when we became more hopeful, when we sort of understood what was at the core of all this. The lack of political leadership is an issue, yes. But if you look, and the book covers the history of liberal democracies, is that you end up getting to the right leadership. It's hard. It doesn't happen as quickly as we'd all like to, because at the end of the day, the people, the citizens need it. They want it. And there is a lot of concern right now about inequality, about climate change, about what's happening around the world. So people are looking for leadership, and the hope is that we will get there. We will iterate to that.
Let's bring it back to the leadership at the Fed and the role that they are playing in some of these global issues. Housing affordability, of course, is a big topic as well. We've talked consistently about this notion that the Fed could break something. We saw a little whisper of it earlier in the year with some of the banks. Where do you see the highest likelihood of something breaking now?
The reason why you can break something is that if you get your initial call wrong on inflation, you lose valuable time. And if you lose valuable time, you end up doing what the Fed had to do, which is play massive catch-up, scramble to play catch-up, which means you end up with the most concentrated cycle, and it's not well-timed. So this most concentrated cycle has happened at a time when we also have a fiscal issue. We also have a rundown in savings of households. And the average person right now is not only facing interest rate risk, meaning that they have debts that are being refinanced at much higher rates, whether they are a household, a business, or a government, the interest rate bills are going to go sky high. But also, the outlook for the economy weakens, which means income becomes an issue. For the marketplace, it means not only do we have to worry about interest rate risk, but we have to worry about credit risk and liquidity risk. So that is the problem with being late. You cannot catch up easily without the risk of something breaking. And that's where we are today. In addition to that, there are genuine questions, Julie, about critical inputs into monetary policy. Economists disagree. What is the equilibrium interest rate? What is R star? Economists disagree. How much of the lagged effect of the hikes have we already felt? No one's quite sure what the impact of quantitative tightening, reducing the balance sheet, is going to be. And on top of that, all that, we have the wrong monetary framework. And in my opinion, most economists agree on everything I've said. There is some disagreement on what I'm about to say. We have the wrong inflation target. So even if you abstract from all the problems, the deep hole that the Fed dug itself into, we have these genuine uncertainties about monetary policy going forward.
Ooh, deep breaths after that one, Mohammed. Well, we'll see what Jay Powell has to say today. I suspect he's not going to be changing his inflation target. Mohammed El-Erian, it's always great to speak with you. Thanks so much. Mohammed, president of Queens College at Cambridge and chief economic advisor at Allianz. Thanks again.
Thank you.
We'll keep it right here. We're sending it back to the Nasdaq market site for Brad and Shauna. Coming up next, they'll have all your markets action. You're watching Yahoo Finance.
Taking a look at our market movers this morning, American Airlines reporting a turbulent third quarter earnings today, posting a $545 million loss and slimming down its profit forecast for the year. The airline saying higher fuel costs and a new pilot labor agreement, they were contributors to increased operating costs. Alaska Airlines, we're also tracking them this morning, facing similar headwinds. The airline seeing higher fuel costs eat into its bottom line, and that outlook to end the year is looking a bit more positive. It's expecting revenue to go up between 1 to 4% on the top end, which is about 7% to 8% higher than last year. I want to kind of zoom back to American Airlines here because there's a lot to break down here with one of the largest operators here in the U.S. and particularly the detail that they're adding on about the quarter. Most notably, I think about how for the third quarter, and we're going to hear a lot about the completion factors that are taking place, especially as that is looked at as one of the larger kind of marketing items that, especially going into a holiday season and amid a holiday season, that's going to be accounting for some of that high volume that they see among passengers and travelers, where they're going to be looking to see how they can market that to those travelers. That completion factor was a record for this company, for American Airlines, in the third quarter. And we'll see if consumers kind of latch onto this message. For Alaskan Airlines, similarly, you heard them talk about how they had the highest completion factor in the entire industry here. But ultimately, it's also still about a liquidity game in this. Ended the third quarter with approximately about $13.5 billion total available liquidity here. So that a few of the numbers to keep in mind as you're kind of reevaluating or just evaluating AAL and Alaskan Airlines here this morning.
Yeah, I think it also comes down to just how much pricing power these airlines still have, right? We talk about the pent-up demand, what we have seen just in terms of people, it almost seemingly felt like willing to spend anything to go on those trips. And that narrative has certainly started to change here. Obviously, we know consumers have been under pressure with the very sticky inflation that's starting to affect how they are spending, whether or not they are still going on those trips. So we have seen airfares pull back just a bit. But in terms of that demand picture, we heard from American Airlines CFO on the earnings call saying that it is consistent with the recent trends, and they do expect to see that steady demand during their upcoming peak holiday travel season. Of course, we know that the higher labor costs as well as higher fuel costs could offset some of those gains that they are expecting to see here in the current quarter. But when it comes to what we saw last quarter, clearly there's been a theme this earnings season among these airlines so far. The higher fuel costs and also the higher labor costs certainly eating into some of the profits, some of the earnings that we've seen from it. And American Airlines, no different. Their fares were down from a year ago. They see unit revenue dropping about 5.5% to 7.5% from a year ago in the current quarter here. But it'll be interesting to see how much of an impact they do have. We know that they do also have exposure here just in terms of that a wide exposure, large exposure to the international travel, which we know has been outperforming there. So whether or not those trends stick, I think is a big question mark here for some of these companies. But as you can see, that 1 year chart shares right around 11.77 a share. So we haven't seen too much movement here since the start of the year, but at least for today, shares in the green, up 3.5%.
Yeah, they struck a new 52-week low yesterday. We'll see how they move here today. And of course, this is the first year where we could see a full year passenger throughput number actually surpass pre-pandemic 2019.
All right, let's talk about another mover that we're keeping an eye on today, and that's Taiwan Semiconductor. They beat the street's estimates for the third quarter. They're also seeing some early signs of demand stabilization in the PC and smartphone market. You're looking at gains of just about 4%. Although TSMC had a positive Q3, they're still seeing the largest profit decline since 2019. The company is saying that they expect inventory digestion and also a weakened demand in China to continue throughout the end of the year. So, yes, we're looking at, I guess, a decent reception on the street. You're looking at revenue off about 14.6% on a year-over-year basis. Earnings per share coming in at $1.29. But some of the comments here from their CEO sticking out to me is saying that while AI-related demand continues to be strong, it's not enough to offset the overall cyclicality here of their business. Certainly saying that some of the troubles that we have seen, not only from TSMC, but also from some of their competitors as well, just in terms of that lackluster demand or the return to demand not meeting what we had initially forecasted, being one of the reasons for caution on the street right now.
Yeah, their expectations for the fourth quarter here, they expect their business to be supported by what is a continued strong ramp of 3 nanometer and partially offset by consumers or customers' continued inventory adjustment here. But I mean, looking at some of the data from this corner, I mean, it's really just astonishing looking at the move today and contrasting that against what the company had to say for the third quarter. Revenue decreased 10.8%. Net income, diluted EPS, that both decreased by about 25%. They're round figures. So really a lot of kind of head scratching, I would think, as you're looking and looking for a reason as to why we're seeing this move higher here today. But one of the other demand environments that's going to be critical for us to keep in mind here is how much capacity on a competitive basis is being brought online by some of the other fabrication plants, especially here in the U.S. when you hear about some of the government initiatives to make sure that there is more capacity brought online to decrease reliance of a company on a company like TSMC. That's going to be noteworthy here, especially for some of the nanometer, 3 nanometer. I love talking about nanometer technology. Why not? This is one of the only times that we get to do it over the course of the earnings season. But 3 nanometer technology accounting for 6% of total wafer revenue, and then additionally 5 nanometer technology accounting for 37%, 7 nanometer 16% in this most recent quarter here, while there's another part of the total wafer revenue that's about 59%. That's advanced technologies, 7 nanometer and above there. So, that's all your nanometers. Now, let's get to some trends. Union Pacific shares, they are on the move here. This comes after the railroad company profits topped analyst estimates, but the full year outlook remains relatively unchanged. It expects softness in consumer volumes to drive full year expectations below industrial production levels. The company is citing inflationary pressures and a drop in carloads to blame for a lower net income and earnings per share. Taking a look at shares, up by about 4% right now.
Yeah, I think lots of questions just about the new direction of this company under their new CEO, Jim Vena. He took over for Lance Fritz right around mid-August here. So this current quarter is going to be the first full quarter that we see here under this new CEO. In terms of the direction of the company moving forward, obviously some of those macroeconomic pressures has been felt when you take a look at the railroads and some of the pressure that those stocks have been under here as of late. You're looking at a 5-day chart right now. We saw a spike, obviously, today on the heels of this report, up just about 4%. But over the last 3 months, the stock has been essentially flat here. But Vena making some interesting comments in this release, saying that we faced many challenges in the quarter, including continued inflationary pressures, that drop in carloads, like you just mentioned. But he does see momentum in the current quarter. And I think that's really the key here for investors, exactly what this railroad is going to look like, rail company is going to look like here this current quarter and moving forward, because we know that Vena has certainly been tasked with trying to improve the services part of the business, trying to improve the customer relations part of the business, which had been damaged due to the supply chain backlogs, a number of factors that have played out over the last several years, especially during the height of COVID. And Union Pacific is the company that has been and will continue to lean on efficiency, one of those key words throughout the earnings season across industries this year, and certainly no different here for Union Pacific when you take a look at some of the recent changes that the company has made, trying to adjust their business in order to meet what demand looks like right now.
Absolutely.
All right, let's take a look at another mover, and that is Nokia. Shares on the move this morning. The telecom company releasing its Q3 earnings report, missing Wall Street expectations, but it does expect to see normal seasonal improvement in their network business next quarter. You're looking at losses of just about almost 10%. Now, Nokia also announced plans to cut 14,000 jobs. That's about 16% of its workforce, and that's going to happen over the next 3 years. So we take a look at this company, the lackluster results here. They don't expect a market recovery soon. They're seeing weak demand for their 5G equipment. They posted a 20% drop in third quarter sales. So yes, when you take a look at that longer term, I guess some of the commentary that they made just about the business division could be a bit encouraging here, but clearly, like you're looking at with the stock reaction today, shares off nearly 10%, and the CEO saying that mid to long-term market things look okay, but that short-term, what exactly that looks like. Clearly a very challenging time for Nokia.
Yeah, some of the high-level kind of bullet points that the company pointed out here. Q3 net sales declining by 15% year over year, constant currency 20% reported. Enterprise net sales grew 5%, but this really just comes back to this gross margin decline that they saw as well here that is going to impact jobs, already has based on the announcement that they've made and what's been acknowledged here in those 14,000 jobs that are going to be cut. That comparable gross margin decline was 39% here, and due largely to the decreases that they saw in mobile networks. And so even as we think back to some of the cuts that have taken place at the start of this year and cuts now that are being made at companies like Nokia, where they are seeing some weakness in specific parts of their business, especially in that mobile networks business, where there had been perhaps overhiring that took place at a certain point of the labor market dynamics. And now you see more of the propensity for companies that have some of the larger margin hits like this to quickly make the decision on a headcount adjustment front instead of trying to figure out, okay, what is the larger kind of implications if this continues, if we do see continued weakness in the mobile networks division, because that mobile networks gross margin, it improved a little bit seasonally, or that's at least sequentially due to some favorable regional mix. But again, that operating margin declined by about 8.5%. A lot of these margin pressures that the company is seeing reflected directly in this decision to make some of one of the most drastic cuts that I think we've seen over the course of this year in terms of total figures announced. Also here, we got to talk about Representative Jim Jordan. Fails to win the House speakership vote for a second time this week, actually doing worse than he did during the first round on Tuesday. Jordan is vowing to stay in the race, though, while his rivals are seeing the signs and beginning their own efforts for the speakership. The chamber continues to be at a standstill, and we're less than a month away from facing a government shutdown. That's when the 45-day stopgap funding bill is set to expire. Will Republicans be able to rally around a speaker so the House can move forward with passing an appropriations bill ahead of the November 17th deadline? That's the big question mark. And for more on what's on his radar and some of the answers here too, we've got Yahoo Finance's reporter Rick Newman. Hey, Rick.
I'm not sure I have any answers. I don't think anybody has answers. But the short story here is the children are still bickering. The speaker follies among the Republicans continue. There may be yet another vote for Jim Jordan today so that he can lose even more votes. Maybe they'll just keep voting for him until he gets 0 votes. I really don't understand the strategy here. But what is coming into view is, okay, they can't really elect a formal speaker, so maybe they will go this route with the interim. They will provide more power for this interim, the Speaker Pro Tem, Patrick McHenry. If that happens, what it could mean in terms of legislation that might passes, the Senate actually will originate legislation. The first one would probably be this national security bill that we've been hearing about, with more aid for Ukraine, for Israel, for Taiwan, and some border security funding. And that would go to the House. And instead of going through the usual procedures in the House might just take that whole bill as it comes from the Senate and have to put it right on the floor and either pass it or not pass it. We'll see what happens there. And then in terms of funding the government, if they cannot get to an actual speaker by mid-November, when those temporary funding bills expire, it could be the same thing. The Senate writes the bills, they go to the House, and then the House votes up or down on what the Senate provides, which is not a very satisfying outcome for people who think the Senate is the one that ought to originate these bills. And that's the way it works according to the Constitution. Any bill that involves money is supposed to originate in the House, not the Senate. But look, Republicans they've just basically abrogated the power of the House at this point. So it's like it's going to be a rump House of Representatives until Republicans can get their act together. There are some new names surfacing for somebody who's not Kevin McCarthy, not Jim Jordan, not Steve Scalise. But who knows if anybody can get a majority of votes in the House, given how absurd and ridiculous this process has become.
And Rick, when we talk about where Congress is right now, especially the House, in terms of the fact that it can't elect a speaker, at least at this point, we're going to hear from President Biden tonight. He's expected to deliver an overall Oval Office address here. A lot of that is going to be, or some of it, I think, would be speaking to Congress. He's going to be looking for more aid when it comes to what's needed overseas with Israel. What are we expecting to hear from President Biden tonight?
we're going to hear one thing from him that we have not heard before, which is, I hope, this should be what he accomplishes, which is a solid rationale for why we should provide more aid to Ukraine. Biden has been very talkative about Israel. He has earned plaudits for the clarity, the moral clarity he's offered, and his complete vigorous support for Israel. And by the way, when he was in Israel yesterday, he provided some caveats to that. He went further and he said, we support Israel for as long as it takes, but also we are urging Israel to be very careful and not make some of the mistakes that people are afraid they're going to make, killing civilians in Gaza and so forth. So he has already made that case. He will reiterate that, but he's going to make the case for why we should provide many billions of dollars more for Ukraine. And we've talked about this many times. I think there's a solid case for that. But Biden has never made it. He's never said, here's why this is worth U.S. taxpayer money, and here's what we expect to get for it, or we are getting for it. And then he will probably add in Taiwan. We need to throw in some money for Taiwan here, and also border security, one of Biden's weakest issues. And then I think probably a subtler message is Biden is going to be trying to persuade people, look, I'm getting stuff done. I'm acting presidential. I'm acting like a statesman. What are Republicans doing in the House? They're acting like fools. So he may drive that point home, and this is a win for the shabby performance of the Republicans is a win for Biden. It is a year until the election. Who knows how this will play 12 months from now? But for now, it should help Biden.
We'll hear from President Biden tonight, 8 p.m. Eastern Time. Rick, as always, thanks.
Bye, guys.
We'll keep it right here on Yahoo Finance. We've got all your market action live from the Nasdaq market site. We'll be right back.
Welcome back. You're watching Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. We're here at the Nasdaq market site in New York City, 34 minutes into the start of the trading day. Let's take a look at how things are shaping up for you right now. First and foremost, stocks, they're treading water ahead of a speech from Fed Chair Jay Powell. That comes later today as jobless claims surprisingly fell to 198,000 for the week ending October 14th.
And some individual movers today. We got to take a look at Peloton. Shares are sinking after Bank of America downgraded the company to underperform and also cut its price target to $4 a share. Now, analysts saying that the company's shares do not reflect the risk here to revenue, and also pointing to increased churn from declining platform engagement and its aging subscriber base. We're looking at losses of just about 0.8%.
We're also watching shares of AT&T. They're jumping, as Destiny's Child would say, after beating analyst expectations in its third quarter revenue, rising 1% on a yearly basis to $30.4 billion and adjusted earnings of 64 cents per share. The telecommunications giant also raised its guidance for free cash flow, driven by growth in its core cell phone business.
And Blackstone stock is moving lower today. Higher interest rates and also a pullback in deal activity taking a toll on the firm in its most recent quarter, causing a 12% decline in quarterly profits. Now, Blackstone also seeing a 50% year-over-year drop in net flows. The company saw net flows pull back by 50% over the year. Now, Blackstone President John Gray pointed to the current environment of uncertainty that is weighing on transaction volume. You look at losses of nearly 5%.
Well, Choice Hotels went public on Tuesday with its nearly $8 billion bid to buy Wyndham Hotels and Resorts after negotiations fell through previously. Wyndham's board rejected the offer unanimously, calling it underwhelming. Yahoo Finance executive editor Brian Sozzi has the latest on this. Brian, take it away.
All right, thanks so much, Brad. Yes, joining us now is Choice Hotels President and CEO Patrick Pacious. Patrick, great to see you here. So the vibe on the street, a couple days after you made this offer for larger rival Wyndham, is that this is now a hostile situation. My question to you, do you see this as a hostile situation?
No, we don't, Brian, and thanks for having us on. You know, after 6 months of dialogue, we really thought we were making progress with the Wyndham team in the early part of September, where we offered them to really come in and look at our books in a one-way NDA, which is pretty unique, to really get over some of their initial concerns. And, you know, really at the end of September, they decided to disengage. And so by bringing our proposal public, which we think is very friendly to shareholders, very friendly to franchisees, both businesses are franchise companies, it really gives us the opportunity to explain our offer to a larger group of stakeholders and hopefully get constructive engagement with Wyndham going again to really drive what I think could be a really value-creating opportunity for their shareholders, our shareholders, and both sets of companies' franchisees.
So, Patrick, this really blew up on Tuesday. Lots of focus on the deal. In the hours since, have you heard from Wyndham?
Not directly. They put out their sort of comments on why they disengaged. And again, you know, I think the areas of disagreement are all resolvable through constructive engagement. And so we're hopeful that through the conversations we're having with their shareholders, with their franchisees, and I'm sure we'll be back in touch with them, we would hope to get back to the table and have constructive engagement to really put together, I think, a company where both of us are better together and is really a pro-competitive, pro-shareholder, and pro-franchisee opportunity for everybody involved.
There really is a good bit of shareholder overlap. Vanguard, BlackRock, a lot of big institutions invested in both your companies. Those companies and many others have long viewed hotels as a really good bet. Have you started sounding out some of Wyndham's shareholders to see if they would support your deal ultimately?
Absolutely. We've been engaged in those conversations in the last 2 days. It's one of the benefits of making our proposal public is it allows us to now engage that set of stakeholders. And everybody sees the strategic rationale. And I think a lot of our shareholders, their shareholders, particularly the ones you mentioned, Brian, that overlap, would like to see a deal get done. And the way that happens is we return to the negotiating table and have some constructive engagement.
Is it fair to say the Wyndham, the ball is now Wyndham's court? Just given what you just said about shareholders supporting what you have put forth, is Wyndham, they have to come back to the table, it sounds like, no?
Well, that's up to them, and I'm not going to speculate how they may take this forward. We're in this. We're determined. We're disciplined. If it takes a long time to get back to the table, we're willing to put in the time and the effort to do that. We've got great advisors on our side. I know they do as well. And so I think when you get right down to the brass tacks, there's a real opportunity here that everybody sees. And so getting back to the table is really what we would hope they would be willing to do. And we're certainly willing to work on our end to make that happen.
Do you foresee a proxy battle?
Look, we're well advised. We know what the options are. As I said, I think constructive engagement is probably the right path forward here. But everything is on the table. This makes so much sense for their shareholders and ours, for their franchisees and ours, that I think getting to the table and doing this in a more constructive manner makes a lot more sense.
And Patrick, I've been doing this for a while. I've covered a lot of deals. I have to say I was surprised by how Stephen Holmes, the chairman and former CEO of Wyndham, came out against your company in a very long presentation talking about underwhelming sales, underwhelming margins. State your case. Why is Choice Hotels better fundamentally than Wyndham?
Brian, I can start with the earnings multiple. We have had a 2 to 3 times earnings multiple above theirs for the past 5 years since they've been a standalone company. The market has spoken. Our business is a higher growth business, and their math is simply wrong. We offered, as I said earlier, on the 5th of September to do a unique one-way NDA, come in and let us show you the value of our company. They actually sent over a diligence list. We returned it. And that's why we were so surprised 3 weeks later that they disengaged. They didn't want to see the real math. And so that's really what we're hoping, is that they would come to the table. Our offer still stands. If they want to come in and look at our books, we're happy to share that with them to really demonstrate that our value of our stock is significant. And that, as a key part of the component here, is really beneficial for Wyndham shareholders. We've heard that from some of our overlapping shareholders. They want to be participants in the combined company on a go-forward basis.
Important to note, you're not exactly a rookie in integrating acquisitions. You acquired Radisson for almost $700 million. How has that acquisition gone?
That's gone above our expectations. We promised shareholders we would deliver on $80 million of synergies in what is effectively about a 600 hotel chain. This is a much larger transaction. We have put forth that we think there's $150 million of synergies. And as I said, we're already delivering on the 80 million we really closed on that deal in August of last year. We're ahead of plan. We'll have that 80 million in the books of synergies this year. And so that's really exciting when you think about our opportunities to do that in a combination with Wyndham. Our team knows how to realize these synergies, and it really brings huge value to the shareholders and the franchisees. The Wyndham and the Radisson shareholders, rather, the Radisson franchisees, rather, are seeing significant benefits from this combination. And it's doing the things that they've asked us to do. You know, Brian, as you know, wages are going up, interest rates are going up, insurance costs go up, property taxes are going up. All of these small businesses that own our franchises, they ask us to do one thing: lower our costs. And what we've been able to do for the Radisson franchisees is do that in a significant manner while boosting their top line. So their profitability is better off. We think we can provide the same opportunity for all of the Wyndham franchisees, and everybody wins in the end.
Is a key ingredient to this deal, Patrick, that a Marriott and a Hilton have just gotten super powerful. They're opening new brands. They're aggressively opening new rooms. Their rewards programs are absolute beasts. And you need to do this deal to compete with those two entities.
Well, look, we feel very confident in our standalone strategy, but you're absolutely right. The industry has consolidated over the last several years, and there's a real opportunity for us to create what would effectively be a rewards program on par with those top two companies that you mentioned. There's also Airbnb, VRBO. The OTAs play a big role in this space, Booking.com and Expedia. So there's a lot of ways for consumers to find hotel rooms and accommodations. And so having our franchisees be able to be part of a much larger rewards program benefits everybody. So you're right, the industry dynamics are changing, and we feel like it's important for us to keep up with the times, lower the cost for our owners, and drive more top line revenue to their hotels. That's really what drives their success.
Well, you really, Patrick, I must say, made a compelling case to get this deal done here on Yahoo Finance. Of course, we should note, I reached out to Wyndham for comment. They did not return our request for comment. Patrick Pacious, President and CEO of Choice Hotels, keep in touch with us. We're looking forward to following this one.
Thanks so much, Brian.
All right, guys, back to you at the Nasdaq.
All right, Saz, thanks so much for bringing us that interview. We want to get to some breaking news. U.S. existing home sales hitting the lowest level that we've seen since 2010, 13-year low. When you take a look at some of the numbers here that we are seeing, it fell just about 2% from last month to a seasonally adjusted rate of 3.96 million units. Lowest level, like I said, since October 2010. When you take a look into where we did see some of that activity on a regional basis, it dropped about 1.1% in the South, decreasing 4.1% in the Midwest. dropping 5.3% in the West. It did increase just a bit of 4.2% in the Northeast, but it's really a continuation of the narrative here that we've been talking about so long when it comes to the housing market. This massive jump in rates, it's weighing on affordability. People are not out there looking for homes. They're staying in the homes that they have, given the fact that their rates on their mortgage are so much lower than they are today. People also just simply can't afford to be looking for homes in this market, especially the first-time home buyers, we know, among those most pressured by the current dynamics right now in the housing market. So once again, existing home sales falling to the lowest level that we've seen in just about 13 years.
And the market's not good for first-time home buyers right now. The first-time home buyers were responsible for 27% of sales in September. That's off just a shade from the lowest level since they have begun tracking that data, which was 26%. That was back in November of 2022 here. So you fast forward roughly a year to this point and where the data is being tracked in September of 2023 here, and we are just off of one of those all-time lows here. All cash sales, they accounted for about 29% of transactions in September. That's up from 27% in August, 22% in September of 2022 for that year-over-year comp. And then here's what's interesting here. Some of the second-time home buyers who make up many cash sales, they purchased 18% of homes in September. That's up from 16% in August, 15% one year ago as well. So cash still one of the mechanisms that for the second-time home buyers they are looking to deploy here. But there are also a fair deal of distressed sales that are still part of this figure. Foreclosures, short sales, they did represent about 1% of sales in September. That's roughly unchanged from the last month. So all this considered, it just comes back to where this mortgage rate sits at right now, where people are finding the opportunity to get in a home if they can find the right financing terms. And the 30-year fixed mortgage rate, that average right now for Freddie Mac was 7.57% as of October 12th.
And it's just been heading up since then. We talk about the fact that it's closing in on 8%. And when you take a look at home prices, you would naturally think that if we do see this massive surge in rates, we're going to see some pressure on the housing market. Then, of course, we'd see eventually some pressure on home prices. And that hasn't happened too much. When you take a look at the median price for existing homes here, $394,300 last month, up 2.8% from a year ago, the third month in a row that we've seen that year-over-year price increase. So when you combine that with the fact that rates now closing in on 8%, certainly going back to the affordability point that you made, it's very, very hard for people out there who are looking to buy a home. Whether or not you're a first-time home buyer, it's hard for you to afford what's on the market today.
I'm just looking at regions where I can purchase right now. I mean, it looks like existing.
Getting smaller and smaller by the day for me.
It is. These prices, yeah. All right. Well, we'll go through a regional breakdown another time.
All right. Well, let's take a look at our market commentary of the day. And this is a note out from Jefferies on Meta. Now, this comes ahead of the tech giant's earnings report next week. Analysts there setting high expectations for the company, forecasting a revenue beat in Q3 and also a rise in guidance. Now, Jefferies' optimism is driven by expected growth in advertising, with analysts saying, quote, Meta will continue to innovate on the advertising front, driving higher monetization across its various platforms. So when you take into account why they are a bit optimistic, what exactly this earnings print could look like here for Meta, we have seen a lot of momentum in the stock since the start of the year. Certainly, by far, one of the winners here within the S&P. But you take into account what we could see, Jefferies seeing revenue growth at below 20% on a year-over-year basis. 4Q guidance, not really too much acceleration in growth going forward, but they do see a lot to be optimistic about. They do see 2024 capex guidance of over $35 billion here for the company.
No Threads mentioned in this note. I mean, I get Threads notifications all the time. I imagine some of our viewers might as well here. And I still can't figure out a way to just consistently go back in there, and perhaps that is why it didn't get a mention here, because the engagement is not nearly as deep as we've seen, of course, across Instagram, Messenger, and WhatsApp. That got a call out within this note here as well, saying that deep engagement in Instagram, Messenger, and WhatsApp suggests robust growth going forward as its monetization ramps here. And particularly in the usage and upside scenario there, they're also looking at some of the new features here. Reels particularly making the service stickier, driving new ad units and additional ad Fed budgets here. So that coming back to the advertising point that you were mentioning as well.
Yeah, their base case, 26% upside here from the current levels. They have a price target of just about $400 a share. They talk about deep engagement on Instagram, on Messenger, on WhatsApp. Also, Reels becoming a revenue driver in the fiscal year 2024 after being a bit of a headwind here in fiscal year 2023. So again, the guidance here from the company in terms of what they expect to see, strong revenue growth for the current quarter, and also guidance for the fourth quarter to reflect some of the gains that we saw in the most recent quarter. So we'll see whether or not Meta's going to live up to these expectations.
Especially in the holiday season where more teens are expected to do more of their shopping, not at the malls, but at their fingertips on their phone.
Yeah,
the mobile mall.
A lot of ideas from influencers these days.
Too many.
Instagram. I know it's too many. I agree with you. Sometimes I'm making purchases I don't even need.
How much money do these influencers think I have?
Exactly. I know. It's hard to keep up. It's very, very hard to keep up these days. All right, guys, we got to leave it there, but keep it right here on Yahoo Finance. We've got all your market action live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
The weakening Chinese yuan is leading to sales of U.S. stocks and bonds. As we just learned, China sold the most U.S. securities in 4 years in August. Yahoo Finance's Jared Blickery has the details for us. Hey, Jared.
Hey there, that's $21.2 billion in the last month alone for the month of August. This chart goes all the way back to the year 2000. It tracks how much securities China has invested in the U.S. That's institutional and retail, but almost all institutional, and a lot of that on behalf of the Chinese government itself. You can see for the first half of this chart, they were building up reserves of not only treasuries, but agency securities like Fannie and Freddie debt and mortgage-backed securities, as well as stocks. But what's happening now is we have been engaging in selling, and the rate is actually increasing. So $21.2 billion is pretty significant because that consists of not only treasuries and stocks, but also Fannie and Freddie debt, so-called agency debt. And before, in this year, China had been rotating from treasuries into agency debt, but now they're selling everything. So this is kind of a wake-up call. Now, I want to go to the Chinese Chinese currency here. This is the US dollar versus the yuan, and this is a year-to-date chart, and you can see the US dollar is at the strongest point right now that it has been all year long. And I can show you a 20-year chart. Well, let me dial that down to a 10, and I can show you the incredible volatility this currency has had versus the US dollar, and we are now at the weakest level of the yuan or the strongest level of the dollar since about 2006, 2007. Now, all of this pressure also puts, all of this selling also puts pressure, upwards pressure on 10-year T-note yields, as well as the entire Treasury complex. That's because as China sells, that pushes the yield up. Investors need a higher yield to attract new investors. So you put all this together, China has been in a really tough spot all year long. This is a look at the Nasdaq Golden Dragon China Index, its constituents, and this is a year-to-date look. Let me show you the equal weight. There's more losers than winners, but you take a look at how much a lot of these stocks are down. In the middle row low, we're looking at 11.5% to 24%. By the time you get to this semi-bottom row here, you're looking at drawdowns of 50%, and that is the norm. You can see some outliers to the upside, but they are far and few between. All of this is to say that the People's Bank of China and the Chinese authorities are in a really tight spot. They want to stimulate their economy, but they're facing a devaluing currency. And when that happens, they have to worry about capital outflows. All of this is a vicious cycle and is putting pressure on U.S. yields as well, which puts pressure downwards on U.S. stocks. So you can see it gets a little bit complex here, guys, but the web is very tangled and there's probably more to come.
Certainly probably is. All right, Jared, thanks so much for that. We want to move to the conflict in the Middle East, continuing here to escalate after President Biden's visit to Israel did little to calm fears about wider pressures to come. It's one of a confluence of market risks impacting asset classes from oil to treasuries. But as tensions do rise, how could the fallout impact businesses? For more on that, I want to bring in Abhishek Prakash. He is the geopolitical business founder. Abhishek, it's great to have you here. You have the top 10 reasons, and we want to focus on 3. So first up, the biggest reason here, or one of the biggest disruptions that you see potentially happening, is energy security. What do you think the economic shocks could potentially look like from that? And when we try to put that into context for everyone, how do you see that, or do you see that potentially reshaping the global energy market?
Well, thanks for having me. I think we need to start off with how we view this conflict. When the war started, a lot of people thought that this would just be another war that would end and things would return to normal. But this is actually transforming the Middle East. This is equal to the Ukraine war for the Middle East. So we need to look at this conflict with a very serious lens. Now, as far as energy goes, obviously, 1/3 of the world's energy comes from the Middle East. We all know that. But there are structural changes taking place when it comes to energy. For example, when the Ukraine war began, the EU went to Egypt and Israel to buy energy, natural gas. And now the conflict has started, and Israel has shut down that pipeline managed by Chevron. So the gas going from Israel to Egypt, destined for Europe, that pipeline has now been shut down, in large part because of the Hamas war. You look at the potential for this conflict to grow into a regional conflict, for Iran to get involved, and now you have fears around the Strait of Hormuz. So we need to look at this through the lens of energy uncertainty, that we're facing the potential for another energy crisis. And this could be far more serious than what took place with Ukraine, because at least in the Western world, there seems to be an energy crisis spreading. Nobody seems to have surplus energy to supply. So investors and businesses need to start to price this into their models.
Abhishek, you also mentioned as one of the top 3 things that people should continue to keep a close eye on here is the risk of cyber attack here. How do you see that from your purview?
Well, just as when the Ukraine war began, thousands of companies left Russia. A lot of Western companies left Russia. And that exposed them to retaliatory cyber attacks because they were picking a side. Similarly, as companies pick sides in this Hamas war, they're exposing themselves to cyber attacks. You look at McDonald's. McDonald's is supplying food to the IDF, the Israeli Defense Forces. Israel has just asked SpaceX for Starlink connectivity. So these companies, based on their actions in regards to the Hamas war, may now be on the firing line when it comes to cyber attacks. Equally important is that as countries take geopolitical action on this front, then their companies are now at risk. So executives have three geopolitical fronts to balance when it comes to cyber attacks. They have the Ukraine war, they have growing US-China tensions, and now they have this conflict in the Middle East.
Like we've seen as a result of Russia's war with Ukraine, we saw a number of sanctions put in place by the U.S. When you take a look at what's happening right now in the Middle East, do you see the potential here for sanctions against some of these countries? And I guess, how do you see that playing out? Or what does that mean here for the business community?
Well, right now, the most direct way the U.S. is assisting Israel is through military. But this is not likely to be the end of the road. American assistance is most likely going to expand into other areas. And this creates the potential for more geopolitical red tape, i.e. sanctions. You look at certain reports that came out that said Hamas soldiers were trained in Malaysia. So now this opens a new front where could the U.S. or the West begin to sanction countries that are either have supported Hamas in the past or have supplied some kind of incentive to them for this attack. Equally important is what I call reverse sanctions. Iran just came out and called on Arab nations to sanction Israel. And already you look at U.S. relations with countries like Saudi Arabia, it's in rocky territory. So could we now see, just as the Ukraine war was transformative for geopolitics, could we now see the beginning of reverse sanctions where countries try to sanction America or try to sanction American allies?
What type of economic impact do you believe that further sanctions would then have long term?
Well, it depends on the business, it depends on the industry, but more geopolitical red tape essentially cuts access to markets. It makes trade more difficult. It makes the movement of goods more difficult. And it's also not just a question of the U.S. imposing sanctions. It's look at the trade war between the U.S. and China. There's also the retaliatory part too. And that retaliatory part might not just be on putting a 10% tariff on imports or exports. It could be even restricting visas to talented professionals. It could affect business in all kinds of complex ways. So again, businesses need to look at this conflict not through the traditional lens that this is another war, but through the transformative lens that this could begin to affect areas that were once considered untouchable by geopolitics.
Abhishek Prakash, who is the geopolitical business founder. Thanks so much for taking the time here today and breaking some of this down for us. Appreciate it.
Thanks for having me.
Certainly. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Yields on the 10-year Treasury are inching even closer to 5% on fears that stronger than expected data could drive the Fed to keep rates higher for longer. But more than half of investors surveyed by Bank of America say that they expect yields to fall within the next 12 months, the highest share of respondents on record. So why are they so certain? We want to bring in Yahoo Finance's Josh Schaefer joining us now. And Josh, I know you've been digging into this. So what's the thought process behind that? I guess, why do they see a chance here that yields could come back from that 5% level?
Yeah, Shauna, we've been talking a lot about yields at 5%, right? And so I was curious and sort of awestruck with the amount of people that think that it's going to come down. So when I talked to the Bank of America strategists behind this note about sort of how they deduced what investors were telling us there's really two paths that bring down yields, and these two paths are very different. One is a soft landing and one is a hard landing ending to the Fed's path. When you take a look at that soft landing path, that's sort of where some believe we could be headed now. Inflation hits its 2% target. We don't go into a recession, and the Fed is done hiking. This is a key part of this thesis because we know that yields often peak when the Fed funds rate peaks. If the Fed funds rate is currently at peak, then yields might be peaking right now. But there's another side to this argument that also sees yields going lower. This would be a hard landing. And in a hard landing scenario, the economy goes into a recession. What happens when we go into a recession? Once we get to that point, the Fed would likely want to cut. I should also note this is partially why we suspect some bond investors might not be coming to the market right now and buying up bonds would be if we are going to see that hard landing, maybe the economy is too hot, maybe the Fed has to hike again. And remember what I said, yields usually peak when the Fed's funds rate peaks. So right now, if you're an investor that thinks the Fed's going to hike again, you could get a better yield most likely on the 5, the 10-year, maybe even the 30-year in a month or two if you think the Fed is going to hike again. So that's sort of the key differentiator right now. But harder soft landing, yields might come down in the next 12 months, guys. We're just going to have to wait a little bit.
Yeah, here's hoping. What could drive yields even higher? You started to touch on this a little bit more. What are some of those factors?
It's the Fed, Brad, right? It is the uncertainty in what the Fed is going to do. Right now, you could ask one strategist if the Fed should hike again, and they could say yes. They could say, look at that retail sales report. Look at the jobs report. The consumer's too strong. The Fed needs to restrain this economy. You could ask another strategist, and they should say, you know, I think lagging monetary policy is going to come into play here. Credit tightening is happening, and the Fed has done enough. They just need to wait. Right now, if you look at the January Fed meeting, there's about a 50-50 split on if the Fed will hike rates again in January, or will have hiked rates by that January meeting. And it's that uncertainty that is bringing volatility into the bond market, strategists have told us. And right now, I don't see a lot of certainty coming to the Fed's path. Maybe you guys do. Maybe Jerome Powell will give us some at noon today or a little bit more. But until we have certainty in where the Federal Reserve is headed, investors do not think we are going to lose any of this volatility in the bond market.
All right, yeah. Certainty that we're all looking forward to anytime soon, Josh, and sense of direction. Josh, thanks so much for breaking this down here for us this morning. Appreciate it. Well, the bull market in stocks hit the one-year mark last week, a stretch of upward momentum made possible by the optimism around the Fed achieving a soft landing. But we're at something of an inflection point now, and that could determine whether we get to the next phase. So, is a breakout on the horizon? With us now, we've got Ryan Dietrich, Carson Group Chief Market Strategist. Ryan, always a pleasure to get your insights here. So, perhaps we start with that question. Is a breakout on the horizon from your perspective?
Yeah, Brad, thanks for having me back. You know, we're optimistic, right? I mean, I came on with you guys all year saying there'd be no recession. We're in a bull market. We had the seasonal weakness in the third quarter. I'm aware of the scary headlines that are out there, very real scary headlines. But the economy is still strong. You guys just had a great discussion there with Josh about the economy and how people feel about it. I mean, we'd be in the soft landing camp. We don't even think there is going to be a landing. I mean, again, the economic data looks really strong. So put a bow on this to answer your question. Yes, we think, you know, the potential for a strong fourth quarter rally is real. And just think about this. October is one of these bear market killers. 7 of the last 17 bear markets bottomed in October. We're not in a bear market now, I'm aware, but you've had a lot of corrections and pullbacks also bottom in October, but it usually happens the second half of October. We're caught between the 50-day and 200-day moving average. So maybe a little more back and fill here, but we're optimistic we're going to break out. One final thing, you know, happy 36-year anniversary of the worst day in the history of the stock market. Let's hope we don't see that anytime soon.
Ryan, do you think there are chances that we could see that? We just heard from Mohamed El-Arian last hour talking about the fact that there is fear out there. He sees some fear in terms of the fact that the Fed could potentially break something in this higher for longer environment, this massive run up that we've seen in yields. Is that something that's on your radar?
Oh, absolutely. I mean, it's definitely on our radar, and we're watching it closely. We'll see what happens today at noon, right? With the Fed, what Powell has to say. But again, we're in the camp like your discussion before I came on. I love that discussion. We're in the camp the Fed doesn't need the hike. I mean, yes, the economy is strong, but inflation. I know the CPI print last week was a tad hot. PPI was a tad hot, but a lot of it had to do with shelter. And honestly, if you look at the private data, places like Zillow and Apartment List, the private data on rents is showing negative year-over-year returns on rent. And we think rents are going to continue to kind of, how do I want to put it, put a disinflationary kind of taste, if you will, on inflation going forward. And the Fed can just likely sit back and say, we've hiked a lot. We've seen a lot of tightening. We've seen that out there with different Fed members talking. And we think the Fed is probably done. And I know one final thing here, when people hear this, they kind of get, oh, really? We think there's some similarities between now and the mid-90s. And I'm not calling for a late 90s scenario, but in the mid-90s, the Fed hiked aggressively. You had some indigestion, but then the economy lived on its own, and the Fed was able to cut. The last two times the Fed cut was during the financial crisis and during the tech bubble, and before that, I guess, obviously, COVID. When the Fed's cut before, bad things have happened. Our brains taught us that. But if you go back to the mid-90s, we think we have a similar situation with an economy that can stand on its own with a lot of employment, with a strong employment backdrop. Maybe the Fed can cut into next year, and the market still can do pretty darn well, and that's kind of how we see things playing out here.
We've had a lot of economic meteorologists to this point, Ryan, but I don't know that we've had an economic gastroenterologist, and you just gave us a little bit of that vision here in kind of the historical comparison. When we think about where wages play into this as well, and I liked within some of your notes how it looked back to real incomes and where that continues to rise. What role is that playing in the economy too?
Maybe one of the most important. A year ago, we were looking at some of the same data saying, listen, we're creating jobs. We made 5 billion jobs last year, almost close enough for government work. But now you fast forward, we're still making 200,000 to 300,000 jobs a month. That might come down a little bit, and that'd be normal. But real wages are still increasing, right? Consumption in the last 3 quarters ran at 8%. That's going to come back a little bit. But everyone talks about inflation. And believe me, everyone wants inflation to come back a little more. But when you peel back the onion, so to speak, real wages and real consumption continue to trend higher. And again, just what the Fed said yesterday, right? I forget exactly what it's called, but they looked at the overall net wealth of 37% the last 3 years. The big reason why we've been able to avoid this recession, a lot of people own houses, a lot of people have owned stocks. They have created some wealth right there. But then you look at real wages, and those are still really strong as well. So things aren't perfect. We're aware of that. Manufacturing's not great. Or manufacturing's getting better. Housing's not great. But the consumer is still in pretty darn good shape, in our opinion, here.
And so when we think about the risk of perhaps another inflationary wave and where that might come because of wages, we still have 2 major contract negotiations between the UAW on kind of the union and labor front for the UAW in the automotive landscape. And then additionally in the entertainment landscape, you still have yet to see any firm deal made in the actors' strike that's continuing to move forward. How might that put additional pressure on wages and then pass through to an inflationary pressure?
Yeah, you're right. And it will, right? I mean, that's why they're doing this. But in a way, it's showing the workers actually have the upper hand. We haven't seen this in a long time, right? It feels like. So there's probably going to be more potential strikes that are out there, potentially higher wages. So that can potentially be a little troublesome. The Fed obviously is watching it closely. We haven't seen, obviously, drastically higher hourly wages. The monthly jobs report, first Friday every month. We haven't seen drastically higher wage growth there yet. It's something we're going to watch, and it potentially could be an issue. I'll tell you, though, the one thing gets me, Brad, is energy prices. I mean, it is what it is. If you look at crude oil, for instance, crude oil and consumer confidence are pretty much inversely related. We think crude oil can continue to kind of go higher again as the global economy doesn't have a recession. The U.S. doesn't have a recession. And if energy prices really start to pick up, specifically crude oil, look at natty gas. I know it's winter time, getting colder. People using more natty gas. It's not winter yet, I guess, but winter's on the way. If you start to see drastically higher energy prices, that could hurt consumer confidence, potentially putting some cracks in the overall consumer. Not seeing it yet, but that's one we're watching, obviously.
Yeah, certainly. It could also complicate the Fed's battle here with inflation. Ryan Dietrich, always great to talk to you. Carson Group, a chief market strategist. Thanks.
Thank you.
Well, we've got all your market action live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. We're live from the Nasdaq in New York City. Let's take a look at shares of Taiwan Semiconductor. They are moving to the upside here, up just over 4%. The company beating the street's expectations in its most recent quarterly report. That part of that driven by demand for its 3-nanometer technology. But despite this beat here, it's important to put it in context from what we saw a year ago, because profit is down big from a year ago, falling just about 25% amid some of the challenge that we're seeing more broadly speaking throughout the industry. We want to bring in more Insight Strategy founder and CEO Patrick Moorhead for a little bit more on this, and also some of the broader discussions that are happening right now within the chip space. But Patrick, let's start with what we just heard from Taiwan Semiconductor, because in this release, the CEO there pointing to the fact that AI-related demand continues to be strong, but not necessarily enough to offset the overall cyclicality of their business. What does that then tell us just about the state of the chip industry and some of the challenges that these companies, that the industry still faces today?
Yeah, so TSMC comments came right in line with what we're seeing out there in the PC market, data center, AI, smartphones, and even PCs. And it's really a balance, right? You have this mega growth in data center, AI. You have some continuing burn off in inventory, particularly in the smartphone market. So it's really puts and takes. I think that we're out of the PC and also getting close to the data center growth stage here. I think the smartphone market in Western Europe still looks pretty good for growth. I'm a bit concerned, though, about the China smartphone market. It is a very large one, which is directly related to the state of the China economy.
Is the TSM, the Taiwan Semiconductor that we're looking at here today, one that investors are already pricing in a movement away or a kind of look across this business and realizing that there's not going to be as much reliance on their fabrication process as more capacity gets brought on elsewhere around the world?
Yeah, I don't think investors are factoring in competition from Intel's IFS or even Samsung's increased capabilities in its logic capabilities, where they would fab things like processors. So I don't think that's built in yet. But I do, though, see as Intel gets closer to building out its Columbus foundry with IFS, and quite frankly, TSMC has an issue inside of the U.S. in getting its Arizona foundry going. You could see the bears come out and value the company a lot lower, because right now it's the only game in town for bleeding edge. But Intel is coming on strong, and so is Samsung.
Patrick, some of the pressure that we've seen throughout the chip industry this week, largely coming because of the crackdown that we heard from the Biden administration in terms of the restrictions that they're putting in place for chips sent to China. How should we be viewing this? I guess, how big of a revenue impact do you see this potentially being for some of those names most directly affected when you take into account the exposure that NVIDIA, Intel, AMD, just to name a few, have in that space, and what that means for their business going forward?
Yeah, so there have been export controls for decades on the amount of flops, as an example, that supercomputers could use, chips from Intel. This latest shot across the bow here is very specifically focused on NVIDIA, and because they are the 800-pound gorilla in the AI training market, in particular for this latest generation of generative AI. I don't see as much of an impact on AMD, if nothing else, because they're not participating very heavily in this market right now. If it does become protracted, I do think it could slightly impact AMD's growth potential. But again, this is a net upside for AMD anyways. And I think the same for Intel, who, while they have some data center AI capability out there, it's not nearly the performance right now that the administration is worried about. And you didn't ask me this question, but I'm gonna put this out there anyways. I think when you're talking about cutting off exports of a card that's about the size of a package of cigarettes, it's really hard to keep that out of a certain country. It's very easy to bring in on a boat, on an airplane. So I'm very skeptical that the current embargo of the NVIDIA products in China, the latest one, is going to have any impact on the speed at which China is going to be able to create large language models and other foundational models out there.
More Insight Strategy founder, CEO Patrick Moorhead joining us here today. Patrick, thanks so much for taking the time here, breaking down some of the TSMC earnings here and the broader industry.
Thanks.
Thanks. We've got all your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Welcome back. You're watching Yahoo Finance Live. Disney is pulling back the curtain on ESPN's financials as it looks for a strategic partner. The media giant said profits in its sports TV segment fell 20% in the first 9 months of fiscal 2023, and sales declined 1.3%. This is really the first look that we're starting to get at some of these financials of ESPN, especially since the company announced earlier this year that they were going to begin breaking out these units, and specifically ESPN as its own standalone unit. A lot of speculation back then when they announced that they were looking for a potential suitor to buy ESPN or spin off the company.
Yeah, we know that Disney has been under a tremendous amount of pressure. A few months ago, going back to the beginning of the year, the involvement there from Nelson Peltz, try and fund. Disney made a couple of decisions here in terms of reshaping its business. One of them here just in terms of breaking apart the business, or I guess restructuring the business is a better way to put that, in terms of the three divisions right now, ESPN being one of them, able to fend off Peltz and his team for a little bit. But of course, we have seen a resurgence there with Nelson Peltz saying he's not exactly pleased with where the company is now, and they need to do more to unlock really the potential value of Disney. So exactly what that looks like, this is our first glimpse, like you just said, into ESPN. And we know that this is the crown jewel of one of Disney's divisions here, just in terms of the fact that it is so important. But you mentioned the fact that profits have been falling just a bit. Not necessarily a surprise when you take into account the cord cutting activity going on, the shift that we're seeing in terms of streaming. People are changing the way that they are digesting their content. And as a result, companies like Disney obviously have to pivot how they distribute their content. They're trying to do so. So I think it begs the question as to exactly what ESPN is going to even look like here a year from now, given the fact that we have seen this steady decline in profits, and what that means for Disney and what that means for that the company needs to do moving forward. Also, given the fact that the sports rights are rising. The cost that they're needing to pay to air some of these things, obviously so pivotal here to their business. So up against a number of factors that make it a little bit more complicated when they're trying to determine the direction of ESPN, the best way to go about it.
Yeah, trying to find new sports, of course, different events that are going to be taking place. TGL is one of those that had come in focus, the golf league that is going to be one of the new PGA Tour annexes or spin-off adjacencies, I should say. But looks pretty exciting, actually. So all in, some of those rights that they're looking to make sure that they're maintaining at the same time, while quarter over quarter here, looking at some of these financials here, you mentioned the operating income and the loss that they saw in the quarter that ended December 31st, 2022. That was down $41 million. They saw a loss ultimately all in, and that was domestically, loss all in of $38 million. They ultimately did see a operating income gain here of about $1 billion in the quarter ending July 1st, 2023, and that puts the 9-month total at about $1.9 billion here. But still a lot of question marks as of how much they need to invest to continue to see that operating income growth in the future, too.
Yeah, and the profits here from ESPN branded TV networks, which means ESPN programming on ABC and also ESPN Plus, that fell 7.8% to just over $2 billion.
Absolutely. Time for a quick check of the markets here. We're taking a look, and we've got a look always in the bottom right-hand corner of your screen. Dow, S&P 500, Nasdaq blown up big time, big numbers here right now. They're down, though, by about 0.4% for the Dow, 0.3% for the S&P 500. Tech-heavy Nasdaq flat just barely to the downside here as we get to the top of the 11 a.m. hour. That is all from us today. We've got much more coming your way at the start of the 11 a.m. hour, so don't go anywhere. We've got you covered here on Yahoo Finance.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita with Rochelle Akufo. Here's what we're watching at this hour. Sky-high yields as the 10-year climbs above 4.9% for the first time since 2007. What's the new safe haven for your money?
And profit pressures. Tesla's Cybertruck push could prove costly for the EV maker, but we'll speak with one analyst saying the problem may be Musk himself as Tesla's stock continues to fall after that earnings call.
Plus, subscriber spike. Netflix's third quarter numbers showed its ad tier plan and password crackdown is proving beneficial, but will further price hikes curb consumers?
Indeed, but first let's take a look at how the major indices are faring an hour and a half into the trading day. Seeing a lot of volatility, but the Dow hit currently off about 1/3% or about 108 points. The S&P 500, they're also down about 1/4% there, about 10 points. Tech-heavy Nasdaq there, also in the red. A lot of that driven by some of the sell-off that we've seen from Tesla this morning. And of course, a lot of anticipation ahead of Fed Chair Powell's speech coming up at noon. A lot of investors are going to be looking for some clarity and direction in that higher for longer narrative, as in how high and for how long. Well, let's also check in on the Treasury market. As Akiko mentioned, that we've been seeing some historic moves here. Looking at the 5-year, currently up about 0.7%, currently standing at 5. The 10-year, though, ticking ever so closely to that 5% mark, currently up about 0.8% on the day. And the longest term 30-year yields, that's up about 0.6% on the day, standing at 5%. Well, Treasury yields are inching closer to the 5% threshold on fears that stronger than expected data could drive the Fed to keep keeping rates higher for longer. Now, analysts are now questioning whether U.S. Treasuries are a safe haven amid market uncertainty. Well, joining us now on this is our very own Jared Blickery. Jared, I know you've been following all of this for us.
Yes, if treasuries are a safe haven, investors have really not been feeling that way over the last 3 years. That is the today is actually the third year, or I should say this year is the third year that we're in a drawdown where we have treasury bonds losing money. That is a very odd thing to happen. In fact, you go back 100 years, it hasn't happened before but one time, and that drawdown was about 5%. We're looking at a drawdown of 25% on the 10-year, and those bonds have just been hemorrhaging losses for investors here. Now, I want to go to the Wi-Fi Interactive, and Rochelle, I'm glad you pointed out this chart and brought it to my attention yesterday. This is the Nasdaq 100 versus U.S. Treasuries. So you take the Nasdaq 100 level, you divide it by U.S. Treasuries, and you get this chart that we have on the Wi-Fi Interactive. And what we can see is back around the tech boom, around 1999, 2000, we had a peak, and that's when Nasdaq 100 was advancing. We know that IPOs were very hot, and that subsided, and we gained way towards bonds. And when that ratio reached its low there, in 2002 or so, we never saw that low again. Now, we can also see that it gained 70% to the highs that we are seeing now. All of this is saying, we talk a lot about the concentration in the market right now among the Magnificent Seven. That's Tesla, Apple, Amazon, Microsoft, et cetera. But there are two different things going on. Those 7 stocks are outperforming everything else in U.S. equities. Meanwhile, Treasury bonds and notes have been losing money, and all of that is driving this ratio up that we're seeing on our screen to an unsustainable level. And when it crashes, I would expect it to crash similarly to the way it did around 2001, 2002. Now, what this means for investors is caveat emptor, this is a vastly different interest rate environment, macroeconomic environment that we've seen, and we are seeing how prices are adjusting to it. There you go. You can see that ratio on your screen. Now I'm looking at the 10-year T-note yield on the Wi-Fi Interactive, and we can see it as at the highest point since 2006. All of this is to say there are upward pressure on the T-note. 5% is just a psychological target. It doesn't really mean much in the grand scheme of things. A lot of analysts, JP Morgan CEO Jamie Dimon himself is looking for 5.5%. If we do get that higher, even higher for longer and even longer Fed, and those calculations that go with it, we're going to have a difficult time pricing equities in the near term. Planning is very difficult in these environments. That is one of the pernicious effects of price inflation, and probably more volatility in the market instead for the future.
Okay, Jared Blickery breaking it all down for us. Jared, thanks so much for that. Well, Treasury yields, as Jared said, approaching those 2007 highs as the U.S. economy continues to show strength. Jobless claims this morning came in surprisingly low, with only 198,000 people applying for unemployment last week, signaling to a resilient labor market. Now, investors are waiting to hear from Fed Chair Jay Powell at noon Eastern today, kicking off a busy day of Fed speak. Rochelle, Jay Powell, they're speaking at the Economic Club over in New York at a time where, as Jared pointed out, we are seeing those yields rapidly rising, that 10-year yield approaching that 5% level. We spoke to Mohamed Al-Arian, Chief Economic Advisor over at Allianz today, who said that the Fed chair needs to be very clear this time around that there will be no more rate hikes, that things have sort of shake themselves down because of where yields have been moving, essentially doing the Fed's work for them. Take a listen to what he had to say.
So what I want to hear from Jay Powell is not what we're going to hear from Jay Powell, just to be clear. What I'd like to hear from Jay Powell is that we are no longer excessively data dependent. This is the first Fed that hasn't got a single strategic bone in it. It's all data dependent.
Part of the argument, Rochelle, that Al-Arian has been making is that, look, data dependent, when that data is backwards looking, is not getting ahead of where we are today, especially at a time when we have seen those rates rising so rapidly that we've seen that credit tightening essentially doing the work for the Fed.
It's true. And even though he's hoping for what he'll hear from Fed Jay Powell, as he said, he's not going to get it. I seriously doubt Jay Powell is going to suddenly throw out the whole, we're going to be data dependent. They're not going to be moved by just one piece of data. And honestly, after months of fighting the Fed, investors, we've been waiting for that reality to finally set in. And it does seem to be, given the movement that we've seen with bonds, that they're going to be keeping rates higher for longer. We've had a lot of Fed speak, even talk of rate cuts, not even perhaps until 2024 at some point. So that also throwing more cold water here. And then as you think of every single data point that we get that highlights the strength of the economy, whether it's jobs, whether it's consumers continuing to spend even as their credit card bills are mounting up, it shows that the economy, at least there's the perception, keep in mind that lag that you mentioned, that the economy can withstand even more movement from the Fed without breaking anything. That lagged effect, though, still waiting to see that trickle all the way through the economy. So I doubt they're going to get that clarity from Fed Jay Powell. I think he's going to stick to that 2% target, data dependent. So I think investors need to sort of temper their expectations as to what they're going to hear at noon, Akiko.
Yeah, I mean, to your point, the lag effect is really the big unknown right now. And plenty of guests that we've spoken to on the show, at least, saying that this is really sort of peak uncertainty in terms of where the economy is going when you consider, like you said, that the strength that we are seeing in the labor market, the relative resilience in the consumer, and yet you look at where yields are headed, you look at where the Fed policy has moved, how quickly those rates have risen. What does this all mean, going into next year? Certainly something a lot of investors are going to be asking or looking for from the Fed chair's comments today.
Indeed, and looking at the VIX, they're over 19, certainly some volatility ahead. Well, shifting gears now, we're talking Tesla, extending those declines after its lackluster third quarter earnings report. Now, CEO Elon Musk's comments about affordability and the slow Cybertruck rollout adding to the EV adoption fears. Now, we have a Tesla investor joining us to give his key takeaways from that interesting earnings call. Let's bring in Kevin Paffrath, financial analyst and YouTuber. Meet Kevin. Good to see you, Kevin. So, as a Tesla investor, you're so welcome. I know this was not the earnings call that people were expecting. I mean, we're used to the kind of Musk that we see on X, who sort of dips into everything, but this was an earnings call. What were your big takeaways from this?
Oh my gosh, this was terrible. I feel bad for him. Look, he's got a lot of things going on, legal battles, custody battles for his kids now, but it doesn't justify acting like Trump on Twitter, stonewalling the SEC or the European Union, and quite frankly, turning into a little baby on the earnings call. I mean, he was almost in tears. It showed a complete lack of leadership. Tesla's a leadership-less company right now, and it's terrible. That's why their CFO just left, I believe, as well. And this is a slap in the face to everyone. It's not just the shareholders, but it's a slap in the face to the other managers who are still there and the over 100,000 employees at Tesla. For a leader to cry about the economy rather than funneling that and coming up with a plan is pathetic. See, he's slow walking his plans to build the Mexico gigafactory because he's worried about the economy. He's afraid, but he should channel that. And he should instead negotiate with the Mexican government, provide a clear formula. Rates go up, prices come down. It's not that hard. But Tesla still has industry-leading margins, over 16.3% going to gross profit. Out of every $100 they make, $16.30 go into gross profit, beating every other American EV manufacturer and even a legacy auto manufacturer. They have so much going for them, but they should provide a clear formula. They should advertise to higher income areas, and they should provide a clear path for margin expectations. We got none of that. We got a leaderless Elon Musk who was afraid to be on an earnings call, who sounded beat down and like somebody who's basically leading Tesla into a directionless path forward. It's disgusting.
Well, Kevin, regardless of how you interpret Elon Musk's comments, we are seeing that reverberate throughout the EV sector. You look at where shares are among Tesla's competitors, all down, partly because of what we heard from Elon Musk saying that higher rates are sapping demand. Is that the whole story here?
Well, yeah. I mean, look, it's obvious that when rates go up, car prices become less affordable. It's the same thing for home prices. There are less buyers. Now, when it comes to homes, there are also less sellers, so you have a little less fluctuation. But in vehicles, everybody's producing more. So of course this is normal. But Tesla should be playing its strengths here. Tesla's strengths are out of everyone who's in this hard economy. Tesla is still generating massive profit per vehicle, massive free cash flow. The only pure play EV in America to actually be generating this cash flow. There's so much potential. They're so close on autonomy. They're so close on a revolutionary new vehicle, the Cybertruck, which is an exoskeleton rather than an internal skeleton for a vehicle. These are great products, and the people at Tesla should be cheered for this. But we need to know the lights at the end of the tunnel rather than hearing a complaining CEO who's not actually providing that path. This makes people nervous and scared. It makes people want to quit
Kevin,
Tesla
if we look
and not be part of that.
If we look at the sector as a whole, though, I mean, the declines we're seeing today, not in Tesla, but in the names like Rivian, Lucid, I mean, they all have their individual stories. But is that warranted when you consider the higher rates may be sapping demand right now? But I guess the question to you is, does that long-term play for EV demand, does that remain intact still?
Oh, absolutely. 100%. Look, like long-term, 5-10 years down the road, everybody's going to want an electric vehicle. The range won't be an issue. There'll be charging stations everywhere. You'll be able to charge faster. Then you can fill up your tank of gas. These cars are much safer. They're much less likely to catch fire. They're much less likely to roll over. You don't have fuel in the back of your car in the gas tank. These vehicles are phenomenal. The acceleration's better. The handling's better. Everything about electric vehicles is better. Problem is, you have, Elon acting like Trump on Twitter, and he's really frankly upsetting a lot of people. There are a lot of, especially women, which is another demographic Elon should be playing towards, upset and who would never touch a Tesla vehicle. So I'm very frustrated with Elon, but long term, EVs will be dominant. ICE cars will go away. That is very clear. That long-term trajectory stays intact.
And Kevin, I want to ask you about delivery numbers, because one of the things that we're expecting potentially is for more price cuts because Tesla's feeling pressure to meet those delivery numbers. But I want to talk about the game changer that's supposed to be the Cybertruck. I want to play you this soundbite from the earnings call from Musk.
We dug our own grave with Cybertruck. It is going to require immense work to reach volume production and be cash flow positive at a price that people can afford. It will take, I don't know, a year to 18 months before it is a significant positive cash flow contributor.
So if they've dug their own grave with the Cybertruck, what are the expectations? Where does Tesla go from here in terms of the next leg up in terms of growth?
Really, I'm shocked that he would say something like this. The Cybertruck, and he mentioned it in another part of the earnings call as well, the Cybertruck could be the leading source of cash flow for Tesla in the future. But of course, when you ramp a new product, it's going to burn money at first. Of course, when you have a new innovative product that nobody's created before, that you have to create the systems for, the new parts for, whatever, of course it's going to be expensive at first. But a way to phrase this much better would be, look, we are the only pure play EV in North America that is actually profitable on the cars we sell. We're going to reinvest that profit into making what could be the greatest vehicle ever manufactured, the Cybertruck. And in 18 to 24 months, we think that is going to drive the greatest cash flow we've ever seen at Tesla, greater than anything we've ever seen before. That's the leadership we need, because what does that do? It motivates shareholders to support Tesla. Tesla doesn't have as much cash as people think. They're like, oh, they have $26 billion of cash. Yeah, well, they got a pile of $23.5 billion of bills on their desk. They just had to borrow $2 billion more just to stay afloat. They don't have as much cash as people think. So the cash flow matters. And we need that vision that what we're reinvesting for is actually going to be worth it in the future. Otherwise, if I'm a Tesla employee working on the Cybertruck, I listen to that earnings call, I'm like, screw this. Why would I work for this company? Why would I work and spend my efforts on this car if even our leaders like, oh, we're digging our own grave? It is a stupid thing to say. This was a disgusting earnings call. Elon should be banned from the earnings call. Quite frankly, he should just be an outside consultant, because all he's doing now is he's blocking people on Twitter who are criticizing him, and it's disgusting.
Tell us how you really feel, Kevin. Kevin Paffrath with a mouthful here on Tesla, financial analyst and YouTuber. Meet Kevin. Good to have you on. We'll have to dedicate an hour next time to get your Tesla thoughts. Thanks so much for that. Well, shares of Netflix are soaring today, extending its gains after reporting solid third-quarter results after the bell on Wednesday. Here with the key takeaways, we've got Yahoo Finance's Ali Cannell. Ali, subscriber numbers surging. We know that's why investors are cheering on the stock today. But that price hike now, how much can they extend the runway in sub numbers?
Well, Kiko, there was a lot to be excited about in this report. Those sub numbers, as you mentioned, certainly a big catalyst there. But the price hikes that's hitting the U.S., U.K., and France, that's going to help boost margins. That's going to help boost ARM, or average revenue per member. And those were two metrics that investors were really concerned about heading into this report. But we finally have a clearer picture of what the path looks like in 2024. We got some more updates on the advertising tier, on the password sharing crackdown. So my vibe for this earnings call and the report overall is positive. I would say it's a pretty solid report, but let's take through some of the top takeaways from the earnings call. Number one, I have to say that Netflix once again talked about the strikes. They said they are committed to ending the actors' strike, that they were in very productive talks, but then those talks broke down after the actors union really said that they want a per subscriber fee, which we know the studios cannot provide at this time. Another thing to note is on those price hikes. I mentioned how that's going to drive ARM and those other profitability metrics. ARM did decrease 1% year over year in the quarter. That was in line with company expectations, but ARM remains a metric that the company wants to continue to improve on. Those price hikes are going to significantly help with that. Another note on the password sharing crackdown is the company is, quote, incredibly pleased. You can see that reflecting in those subscriber numbers of nearly 9 million. They've taken their time with this rollout. They want to make sure they have all the pieces together, that the tech is good as well, and they expect to continue to see subscribers climb in the quarters to come. But on the ad tier, that's something that's going to need a little bit more work. This is an area that's not fully developed. Netflix said that they are in that crawl phase and that's going to take time to really materialize, especially as they are going after those higher ad dollars. And then with margin growth, Netflix hit 22.4% operating margin in the quarter. That's slightly ahead of its own projection. They said they do expect full year operating margins to hit 20% this year. That's the high end of their 18 to 20% range. They said that should go even higher in 2024 between 22% and 23%. But CFO Spencer Newman spoke about this on the call. So I want to play a little bit of what he had to say there.
We don't think we're anywhere near a margin ceiling. We've got a long runway of margin growth. So again, no change in our objectives, no change in our long-term margin expectations. But at our current profitability and scale, we think it's prudent to balance that historical pace of margin improvement with growth investments.
And those growth investments, that can include areas that the company is already doing, those content initiatives that they're doing both at home and abroad, also new content initiatives like gaming and their live events. So they're going to continue to balance that investment with having healthy margin growth over the long term. They didn't provide any longer term guidance beyond 2024, but they have hinted that Netflix has the potential to see margins similar to other media companies, which historically have been around the 40 to 50% range. So really something to keep an eye on moving forward. But overall, analysts have been combing through these notes. They're very bullish on the company at this point. We'll see if they can continue to hit those targets. But this really sets us up into 2024. And I'm happy that we have a clear picture. And I think investors are happy about that as well.
Indeed, because we didn't know how it was all going to pan out with this pure streaming play that is Netflix. So interesting to watch there. Appreciate that breakdown. Our very own Ali Canal. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Well, California Governor Gavin Newsom signing a slew of new bills to tackle the state's housing issues, with California seeing the highest housing costs in the country. The median sales price is now close to $850,000. That's at least according to the California Association of Realtors. That is up 3.2% year over year. Let's bring in Yahoo Finance reporter Danny Romero to talk more about how these bills are streamlining housing construction and protecting tenants. At the end of the day, is this going to bring down costs?
Akiko, California has a housing problem, from not in my backyard politics to the lack of tenant protections. Governor Gavin Newsom has had enough. He's becoming aggressive in tackling the state's housing crisis. Governor Newsom signed 56 housing bills this week designed to add more housing supply and protect tenants against evictions, and also, most importantly, hold cities accountable for their fair share of housing. If you've gone to any city council meeting or covered any city council meeting as a reporter, those meetings can be lengthy, so time consuming, and at times could even take years to resolve just one issue, especially if that means a development going into a neighborhood and those neighbors are against it. Forget about it. That prolongs the housing supply that market needs. Now there are two bills, SB 4 and SB 423, that are allowing developers of multifamily housing units to bypass some of the lengthy approval processes and pull forward some of that housing supply. There's a study from UC Berkeley that found SB 4 bill would open up 171,000 acres of land across the state for affordable housing. Another bill to really highlight is the AB 1033, which allows homeowners, property owners, to sell their ADU, the accessory dwelling unit, also known as the granny flat, separately from their home. And there's also a big push to add more budget, state budget for those ADU programs. And lastly, the other bill that really stood out is the AB 12. And that actually prevents landlords from taking more than 1 month's rent as a security deposit. And that law is expected to go into effect of next year. But Akiko, it's also important to highlight that California has already passed some housing bills that have streamlined a lot of the multifamily housing units. I've spoken with developers on the ground about the bill, the SB 330 that was passed in 2019. And these developers have said that actually has streamlined a lot of the housing production to the market. So these new 56 bills that have been passed that have been signed by Governor Newsom will just add more to that effect.
That's interesting. It'll be interesting to see how many other states try and follow suit as they try and manage this low inventory issue that's keeping a lot of homeowners out of the market. Appreciate you as always, Danny Romero. Thanks so much. Well, the 10-year Treasury yield has continued its march higher, pushing ever closer to reaching that 5% mark as investors await Fed Chair Powell's speech at noon. Now, our next guest thinks that through all that, interest rates still remain in the driver's seat for stocks. Let's bring in LPL Financial Chief Technical Strategist Adam Turnquist for more. Good to see you, Adam. So as we look at the rebound in equities and we look at what we're seeing in the yields on the 10-year, what is going to be that breaking point?
I think it could be today with Chair Powell's speech coming up here in about an hour. I think that could be the make or break moment for the 10-year to clear that 5% level. We'll certainly be watching that carefully and listening for any signs of sticker shock with some of these rates that we're seeing on the longer side of the Treasury curve. The long bond is now north of 5%. And as you noted, that 10-year is getting very close to that level. 490 is technically a resistance level that we're watching this week. So we'll see how it plays out as we get closer to the end of the week. I always like to look at those closing prices, but I think if he acknowledges the fact that the long end is doing some of the heavy lifting for the Fed, I think that could pull back or cause a pullback in interest rates. And I think it'd be a welcome message from the market.
Yeah, and how clear does that message need to be? You know, we have seen the Fed chair try to keep optionality there, but really increasingly since the last Fed meeting, given the rapid rise that we have seen in these rates, it seems like this is kind of where the Fed wants it to be without them having to raise rates again.
He does seem pretty steadfast on this higher for longer monetary policy. A few other Fed speakers have talked about the longer side of the yield curve doing that heavy lifting. Not exactly sure if we're going to get that from Chair Powell today. We have had a significant move higher in rates. We also have obviously a much different geopolitical climate since the last time we've heard from him talking about interest rates. So I think that any signs, I think the market in terms of a dovish hint from Chair Powell would be enough to really throw a little bit of cold water on some of this upside momentum in interest rates right now.
So then, Adam, if the 10-year and the 30-year are more so about inflation, the five-year is more about growth, what is the strategy here then, given the volatility that we're still seeing?
I think for just at a high level for investors, they should consider locking in some of these interest rates. We're talking, yields at 5% for risk-free assets. I think it looks like an attractive time when you compare stocks to bonds. That equity risk premium is at historically low levels. So I think at a high level, again, I think it's an attractive time to lock in some of these yields. You don't have to take a lot of duration risk, meaning you don't have to go further out on the curve to capture those attractive yields. You also don't have to go into the high yield space. The corporate or investment grade corporates on the short side for high quality still look pretty attractive to us. And then when you think about inflation in terms of driving yields higher, on the long end, it's really been about above the economy coming in better than expected. If you look at break-even rates, they've actually deteriorated or come in a little bit. So it's really just this resiliency theme that we've seen in the economy driving that higher for longer messaging from the Fed.
What does the broader context look like, Adam? I mean, if we do see the 10-year break above that 5% level and remain there, what does that ultimately mean for the average American?
I think it's going to be a higher borrowing costs. The lingering effects of the tightening are certainly playing into that as well. We're still, talking about another potential rate hike from the Fed. We've seen the 2-year that's more sensitive to the monetary policy already breaking out. So I think that's a little bit of a warning sign. And you can see just how that's impacted some of the consumer discretionary names as well, starting to pull back a little bit more significantly in those names. Of course, rising energy costs are influencing that as well. Big picture, though, I think for the S&P 500, as long as the 10-year continues to trend higher, I think it's going to be a struggle for upside momentum to continue for stocks.
And so I know that you've noted some of the sectors that you like in your notes here. At what point does that change, though?
For now, we think these are durable trends with shelf life. We like energy as one of our favorite ideas, for example. Crude oil continues to work after recently resetting from overbought levels. Natural gas is trending higher as well. We like those supply and demand dynamics. And this is before what's transpired in the Middle East. This is also without really a lot of support from China. That's been an underwhelming area in terms of the economy. And crude oil continues to work, and it's really just those supply and demand dynamics playing out. We have very low supply in the US, production is picking up, but I think that's going to help the overall energy sector. You get high free cash flow yields there, attractive dividends, and broad-based breadth when you look at the energy sector from more of a technical lens.
LPL Financial Chief Technical Strategist Adam Turnquist, good to talk to you today.
Thanks for having me.
Time now for our trending ticker, and today we're taking a look at shares of cloud computing company VMware and chipmaker Broadcom, both down today, with VMware seeing the steeper decline, down more than 9% there. This comes as the Financial Times reports Beijing is considering delaying approval of Broadcom's acquisition of VMware. The two have been negotiating a proposed $69 billion merger since May of last year, but China, as well as South Korea, we should mention, have yet to sign off on the deal. The FT reports Chinese regulators may be delaying approval in direct response to the Biden administration tightening export controls on advanced chip sales to China earlier this week.
All right, well, we have all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What and How are Gen Z and millennials spending their money? Brands are all vying to win over the $100 billion market. There are some surprising and not so surprising winners. TD Cowen releasing a report today on Gen Z and millennial spending habits. They're saying consumers are using social media to influence their purchases, looking for value, and prefer direct-to-consumer brands. More on this report. Let's bring in John Kernan, TD Cowen, Managing Director of Retail and Consumer Brands. It's good to talk to you. Can I start by asking whether there is this direct correlation between millennials and Gen Z? We sort of group them together, but that is a pretty wide range in age.
Yeah, thanks for having me. Look, the Gen Z consumer ranges from 18 to 24-year-olds, and then you have the millennial consumer, which fits into a bucket of around 25 to 34. And their preferences, there is some variance in preferences. The survey we published today in the 100-page plus report that's already had 3,000 investors and corporate clients read the report based on our readership data. What that shows is they do move together, but there are variances. And I think what's unique about our survey is that we are able to look at the differences in spend or preferences from 18 to 24, 25 to 34, and then older demographics as well. So I think the biggest themes that we saw in our survey, you mentioned earlier, the growth of social commerce, the emerging digital and DTC trends that continue to make new highs post-pandemic, and also value and how important that is to young consumers.
And so in terms of the actual spending power and pricing power that affect Gen Z, obviously millennials have lived through a financial crisis. They already know some of that caution there. A different situation for Gen Z. How is that affecting how they're approaching pricing?
Yeah, sure. It's definitely the demographic is much different than than other age cohorts. And we can see that across our data, across their preferences, across their spending habits. They feel fairly uncomfortable from a financial perspective. They expect to cut spend further in 2024 based on the survey data. So value and price is very important to them. We see that manifesting itself through the growth of off-price retail and those younger consumers shopping these concepts like Ross Stores and TJX, which have been big stock winners over the last 3, 5, and even 1 year. So they are buying more and they're focused on value.
When you talk about social commerce, what stands out to you? It feels like that it's so busy, it's so noisy, and yet there are those brands that have been able to cut through the noise, especially on social media. You know, what specifically has proven to be attractive in these demographics you're looking at?
Yeah, sure. The younger consumers, let's level set where how much time younger consumers in the survey spend on their cell phones a day. The average spend 4 to 8 hours per day. But then there's also 20% of the cohort of those younger 18 to 35-year-old consumers that spend 8 to over 10 hours a day on their cell phone. So that amplifies social commerce structural gains. That's Instagram, TikTok in particular. And the influence that they have on younger generation spending patterns and preferences is enormous. And I think what's manifesting itself further is that it's lowered barriers to entry for across a lot of categories in retail, particularly across the soft lines retail space. So things have gotten more competitive because of it. Barriers to entry have come down, and the amount of time that younger consumers spend on their cell phones is truly astounding.
And John, I want to ask about clothing, because usually when people think of, TikTok made me buy it or Instagram did, you think of the traditional social media companies. In your survey, though, in terms of the path to purchase, Amazon remaining the top choice from where some of these consumers actually start looking first, and then Google. So talk about that dichotomy there. What is Amazon doing right?
Sure. Yeah, my colleague John Blackledge covers Amazon and Google, and he's written extensively on these topics in the report. Amazon ticked down in a few areas of path to purchase and also shopping preference in a few ways. So they've normalized from their highs they made during the pandemic. Google, on the other hand, is extending its preference and path to purchase for younger consumers in particular. So those two companies play enormous roles in commerce, right? I mean, they're trillion-dollar market caps. The reach that they have is absolutely enormous. And I think Google, from a search perspective, it continues to significantly influence the path to purchase for all consumers, but particularly younger consumers.
John, you talked about value being a big driver for consumers in, millennials as well as Gen Z, and yet, I was thinking a few years ago, it was about sustainability that we kept hearing, that this is a group that would buy at secondhand shops. They were more aware about how much they're buying. What's shifted? Is it this current economic environment that has sort of swung the pendulum back to cheaper and more?
Yes. I think where we are in the cycle right now, in this consumer cycle, is people are in a very difficult place, and a very different place from where we were in 2021 and pre-pandemic in 2019. Inflation and interest rates have skyrocketed. It's changed the economy fundamentally, and it's changed consumer budgets. And it's changed comfort levels. It's changed animal spirits in terms of how much and where people want to spend. And value really resonated in the survey this year, and consumers looking to cut spend also showed big increases and are very high levels. Sustainability as a purchase decision ticked down from the highs we've seen in the past. And I think that's directly related to people probably searching for value and price value registering more. That said, it still ranks relatively high among younger consumers and higher for younger consumers than it does for older consumers. So sustainability is still a theme. It's just ticking down from levels we've seen in the past.
And John, just very quickly, if you were to think of your top 3 headwinds for these particular groups of consumers in a higher for longer interest rate environment, what would they be?
Yeah, interest rates, borrowing costs, inflation. If it continues on this pace, that's ultimately going to not only eat into budgets, but it's going to keep rates higher. And I think just where we are in the cycle of spending, I think the consumer is going to have a difficult time coming out of this into 2024.
John Kernan, TD Cowen, Managing Director of Retail and Consumer Brands. It's good to talk to you today. Appreciate that.
Thank you.
Well, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Fake or unauthorized semaglutide, the formula for Ozempic and Wegovy, is running rampant in the US, but the EU and UK warn that they too are now seeing a problem. Joining us now, Yahoo Finance's senior health reporter Anjali Kemlani. And Anjali, with just a Google search, you see so many of these popping up, it's hard to know which ones are real and which ones are fake.
That's right. And that's something that the EU and the UK are warning about for consumers, especially because there's already a limited supply in these countries. Novo Nordisk has only really had a supply in the US, and then recently in the past year slowly started rolling out in Germany, Norway, and Denmark, as well as the UK. And so what these entities are saying, which by the way has been happening for about a month, Germany started off finding these counterfeit products, and subsequently other countries have seen them as well. So it's the 1 milligram Ozempic pen. And that is interesting because, as we know, Wegovy is the weight loss drug. Ozempic is the one slated for type 2 diabetes. And so you're seeing the counterfeit products really speaking to the demand still of this product globally. We got notes from the regulators specifying that these labels are in German. They are circulating within the distribution channel, and there's no evidence just yet that they've made it to patients. So they're still finding them before being distributed to patients or being filled in prescriptions for these patients. So that's one good sign, but they're unclear of the source of this, and something that's been going on, like I said, for roughly a month now. Meanwhile, we got a statement from Novo Nordisk saying that the company has seen an increase in illegal online sales, and every counterfeit case that they've been aware of, they've been looking into and relying on third parties, on regulators, and really just the average person to call in all this. And they've seen this since before the start of the year and have continued efforts into 2023. We know, of course, there are shortages of these drugs as well as high unmet demand still. So really an interesting story unfolding for that company still.
Anjali Kamlani, thanks so much for that. Well, weight loss drugs have been the talk of the town for much of the year, as Anjali alluded to. The frenzy over Ozempic and Wegovy saw producer Novo Nordisk rocket to become Europe's second most valuable company. The tailwind didn't stop there, with the likes of Weight Watchers jumping on the bandwagon. Earlier this year, Goldman Sachs upgraded the stock to buy, suggesting the move into the space would mean big business for big things for business. Take a look at those shares this year. Goldman Sachs predicts the total addressable market globally for weight loss drugs could reach $100 billion in sales by 2030.
I mean, Akiko, as you mentioned, it's a big market to take hold of. On the other side of the coin are the food and beverage companies that could lose out if the trend really takes off. Now, a couple of weeks ago, Walmart warned that weight loss drug users were buying less food. We asked some top execs in the industry for their take. Here's what PepsiCo's CFO Hugh Johnston had to say.
We can't detect any impact in our numbers right now. We just don't see any impact at all. That said, let's keep in mind, this is early days in terms of these drugs. There's lots of questions in terms of what the rate of adoption is going to be, both from the perspective that do people want to inject themselves? And in addition to that, the payer question in terms of the drugs being quite expensive. So our assumption is the adoption on these is going to be slow over time.
So still early days there. Now, we also heard from General Mills North America Retail President John Nudi. He struck a similar tone.
What I can tell you is just by the sheer numbers today, it is not having an impact on the food and beverage business because there's not enough people are using it. It's expensive. Insurance doesn't cover it in most cases. And there's a lot to learn. I mean, I saw a fact recently that a third of all consumers that tried it didn't make it even a year on the drug.
Now, our next guest has some thoughts on exactly this. We're joined by Goldman Sachs research analyst Jason English. Jason, thank you for joining us. So as investors are trying to make sense here as to how to actually gauge the effect, on the Walmart side, they were able to sort of track those who were on these at their pharmacies and how that impacted what they were buying. But seeing this appearing in these earnings calls, how are you assessing this?
Yeah, that's right. It's really early innings, as you heard from both Hugh and John. And the sample size of consumers on these right now is quite small. So not surprisingly, we're hearing from these companies that they aren't seeing a noticeable impact. The key point is not seeing a noticeable impact yet. We don't know exactly what the adoption curve is going to look like. As you mentioned in the earlier session, talking about the demand for Ozempic, there's a lot of unstated demand out there, and there are a lot of capacity constraints that are constraining how rapidly that adoption curve builds. There's a lot more capacity coming next year. There'll be more capacity beyond. You're going to start to get oral options coming to the market within the next couple of years, and we would expect the market to really build and become much more substantial. The $100 billion forecast you saw, that's from our pharmaceutical team in terms of the size of the prize for the drugs themselves. That's predicated on, in the US alone, roughly 14 to 15 million consumers getting on anti-obesity medication. We estimate that the figure today is less than 1 million. So you go from less than 1 million to 14 million, you're going to start to feel it. The question is where you're going to feel it. And that's where the focus of the market is today, because the stocks are reacting on this. And many of the stocks, you're seeing a concentrated reaction, particularly around junk food or snack food.
Jason, your report is really an interesting one in light of some of the commentary we've heard from these companies, because it does kind of poke holes at the narrative, right? That this is in fact already having a significant impact on the market. How do you make that direct line, though, from a drug like Ozempic to actual consumer behavior?
So I have to put a lot of caveats out there. Again, it's early, and we're all dealing with a lot of imperfect information. But right now, there's a lot more hypothesis in the market than there is actual data. So earlier this week, we set out to try to answer some of the questions, and we had to make some leaps to do so. So let me walk you real quick through the analysis we did. We noticed that there's a large spike in demand for anti-diarrhea and anti-nausea medicine. It's well documented that that's a large side effect for people on GLP-1. So we made a leap and said it's reasonable to think that many of the consumers who are buying or driving the spike in these drugs could be your early adopters of GLP-1 consumers. If we make that leap, then let's go further and say how else really changing their behavior. So the profile for that consumer is households where the female head of households age 45 to 54. You got kids age 6 to 17, and generally making middle to upper middle income income. So generally middle-aged adults, likely a female bent, because we see that with Novo's Wegovy data, with families. That's who our cohort is. And when we look at where the behavioral change is happening, in some areas it was consistent with expectations, in some areas it was surprising. So areas of growth, vitamins, minerals, supplements, protein shakes, protein bars. Okay, that makes sense. Other areas which were interesting but not incongruent, beauty products had a big spike. You get leaner, you want to look good. This is supportive of the notion that general apparel may also see a boost in this as people look to refresh their wardrobes. Where we saw some surprises was that it wasn't junk food being disproportionately damaged. Instead, it was actually more healthy food. So weight management bars saw the largest drop in demand with this cohort. So did salad dressings. Meanwhile, confection relatively unchanged, salty snacks down, but really down no worse than most food. And by the way, most food demand was down, which is, you're talking about caloric destruction here. But the profile that starts to fall out of this is that the early adopter of these drugs may actually be somebody who's already been out there trying to fight the good fight, live a healthy lifestyle, eat healthy and lose weight. So we're seeing demand get destroyed for those types of foods, not junk food. Again, this is early, and maybe the GLP-1 consumer looks very different 3 or 5 years from now, particularly as insurability grows. Maybe Medicare and Medicaid start to approve that, which currently it's not covered under those.
And Jason, you raise an interesting point, because if the drugs are already sort of helping people lose the weight, it does make sense then that some of these healthier snacks that people have been trying to rely on would then also see a reduction in demand here. So then at what point will we see sort of more widespread adoption based on the pace that we're seeing at the moment?
A lot of it comes back to supply. We know demand is high. There's surveys out there showing that roughly 54% of women are interested in looking at these drugs. So it's closer to 30 some odd percent for men. So there's awareness, there's interest, there's not availability. So we need a lot more availability of the drug. Our pharmaceutical team has built their anti-obesity medicine model with contemplation of both the demand and the supply. And they're looking for a pretty gradual ramp from less than 1 million consumers today to around 14 million in 2030 with a steady linear progression. If we get to 14 million consumers, based on the data coming out of some of the clinical research that shows a 25 to 30% reduction in caloric intake for consumers on this, you're looking at 2% destruction of calories in the US. But it's spread over almost a 10-year duration or a 7-year duration. And so we get to 2030 from 2023. That's around 30 basis points of calories destroyed every year. not really that noticeable unless, of course, it's concentrated with between a few categories. The 80-20 rule applies for many categories, particularly food and beverage, and that's that 80% of consumption comes from 20% of the consumers out there. If it's that 20% of consumers for a particular category that ends up on these drugs, then we may not be looking at 30 basis points. We could be looking at a couple hundred basis points of destruction on an annual basis, which is why understanding not just how the consumer's caloric intake is going to change, but where we're going to see those changes becomes so important from investors out there.
It is a fascinating report, Jason. Appreciate you sort of breaking it down for us. Goldman Sachs research analyst Jason English.
Thanks for having me.
Well, Google is betting big on India, announcing it will begin manufacturing its smartphones there, beginning with its Pixel 8 next year. Yahoo Finance's Dan Halley is here to break down the details for us. Dan, how much of this is about just the Indian market, and how much of it is about finding an alternative to China?
I think it's column A and column B. I think, the getting into the Indian market is absolutely massive. Let's put this in perspective. The Pixel brand for Google is, a drop in the bucket. It's a means for them to show how manufacturers should be putting out Google phones. It's to showcase Google's AI technology and its chops, and they've done that with the Pixel 8 and the Pixel 8 Pro. This specifically mentions the Pixel 8, though, not the Pro, which is a more expensive model. Still, both of them have the same AI capabilities, and I think what Google wants to do here is, get a greater foothold in the Android market overall, and then B, show what its AI capabilities have to offer outside of just, the more developed markets. And the fact that the majority of smartphones in India are powered by Android means a lot here. So I think that that's definitely part of the equation. The other is, as you said, the manufacturing aspect and moving into India. Well, to really try to sell in India, you have to have some kind of manufacturing presence. And so they're going to be doing that through domestic and international partners to try to get these built there. But I do think part of it is ensuring that, they don't have to rely on countries like China. And so this is a push that we're seeing from other areas of the world, or other companies in the world, whether that's Apple, which is increasingly moving the iPhone into India. We saw there's the iPhone 15 is being built there. And so that's something that you can expect to hear from manufacturers across the board. But I don't think this is really too much of going to be too much of a gas on the fire for Google overall as smartphone sales go.
Certainly a story to watch, though. Appreciate you getting us up to speed. Our very own Dan Howley. And just some quick news here out of the House Speaker race. Jim Jordan will reportedly suspend his bid for the spot and instead back Patrick McHenry to fill the role on a temporary basis. That's according to several media outlets. Obviously, that's that's something that markets are not as concerned about, more concerned about what they'll hear from Powell coming up in just a few minutes, though.
Yeah, I mean, Rochelle, it's worth noting this comes on the back of that second round of vote for Jim Jordan. He actually lost votes in that second round. So having Patrick McHenry empowered here as the House looks at more stalemate and an empty seat here at the top, probably a lot to do with having to push forward that legislative agenda as well. And we could see some more support behind that idea.
Indeed, the saga continues. Well, that's it for now. I'm Rochelle Akufo alongside Akiko Fujita. Thanks for watching. Stay with us.